Here we go. Hit it.
It's May 15, 2020, episode 80. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome Vincent Deluard, macro strategist of INTL-FCStone. Vincent talks Europe and the problems with COVID-19, introduces to the whole European Union. And then we move to the generational shift that is about to envelop developed economies and what that might mean for the markets in the future. Then we have the special privilege of having the author of Flash Crash, a Trading Savant, a Global Manhunt, and the most mysterious market crash in history on the show. Liam Vaughan's book tells the story of Nav Singh Sarao, the trading whiz kid who made almost $100 million day trading S&P E-mini futures from his parents' childhood bedroom home. Then we get to my favorite portion of the show, talking charts and other mystical incantations with Periculum Patrick.
And then we get to This Week in Trading History, where we go back to the Great Potato War of 1976. Then we get to the WTF Clip of the Week and finish with the top 3 things to watch next week. So let's get to the interview.
Vincent Deluard is the head of global macro research at INTL-FCStone, a prolific market commentator who's often quoted in the Financial Times, Wall Street Journal, Barron's, Real Vision, and Reuters. Mr. Deluard earned the Euromoney Patriotic Falloon Prize for his in-depth study of the investment opportunities offered by the European debt crisis in 2013. Prior to joining FCStone, Vincent served as European strategist for Ned Davis Research Group, where he authored weekly publications on European markets and designed proprietary trading models that combine fundamental, technical, and macro indicators to identify major investment themes and market trends. Vincent, it's a pleasure to have you on the show. Welcome.
Well, thanks for having me. It's a pleasure to be here.
I am looking forward to this. I read your research material with just a big grin on my face because it's none of this doom and gloom kind of deflationary crap that Patrick makes me read all the time. It's stuff that's near and dear to my heart. But before we do that, let's go over your career, your history, how you got to San Francisco. You're originally, from France, right?
Yep, I was born and raised in Dijon, mid-sized town in Burgundy, France. And I went to school in Paris. I was lucky enough to get a scholarship to go study in New York for my master's degree. And this was pre-08, which meant that anyone who could open an Excel spreadsheet could get a job as a research analyst, which I did.
That would have ruled out Patrick, though.
Oh, no, wouldn't have.
So I started in I think 06, initially tracking flows and buybacks, which I didn't think all that much at the beginning, but the more I thought about markets, the more I thought that was quite important to understand. And then I went on to run the Europe product for Ned Davis Research Group. And for the past 5 years, I've been running the Global Macro product for INTL-FCStone.
Right, FCStone. So, but when we were chatting earlier, you went through your history of your university degree, and you studied under a couple of famous people. So I gotta ask you about that. So first of all, what university did you go to?
Well, in France, if you have good grades at school and you don't really know what to do, the path is chosen for you, and you go to become a high-level public servant. So you go to really 2 schools, Sciences Po and then École Nationale d'Administration, which I had left before that. And then Sciences Po is kind of like at least it used to be, a training ground where politicians and ministers and kind of trained the future generation. So you have it was fascinating for me because I did not come from that background at all, but I was able to interact with people like Dominique Strauss-Kahn, like Emmanuel Macron, who was a TA when I started, even though he was just a few years older than me. But he's very early in everything that he does. So it was a weird experience, but ultimately one that left me unconvinced that this was what I wanted to do with my life.
So Emmanuel Macron put you off politics, and
No.
Strauss-Kahn for sure did.
I have nothing bad to say as far as I can tell. He was very, very friendly. Had coffees and drinks with students and prepared his classes. But it's it seemed like a path that would get narrower and narrower as you walk by, and it's somewhat like a ladder that gets smaller and smaller, and everybody is like kind of thinking of, okay, how do I get to the next step on that ladder? And really, you don't ask yourself like, well, where does that ladder lead? And especially from kind of coming from a different social background, there is always a question that, is it real? Like how is any of the things that I'm studying right now make me qualified to do the things that people tell me that I should be doing later? And ultimately, I was just happy to get out. But I mean, it's a system that has produced great things also, and that works for some people. So I don't want to be too negative on it.
Yeah, and I was just fascinated when you told me the two professors or people you interacted with, and I was like, boy, those are the. Me knowing very little about French politics, even I know about those two fellows. So let's talk about, you moved to the U.S. and you get a job doing buybacks and or studying the buybacks, right, and the flows. Tell us a little bit about that, and what was it like in terms of a culture shock moving to the U.S.?
Well, one thing that's just different about the US is how much the stock market matters. I would say, unusually interested about finance and economics as a kid and a student, but that came mostly from coins or from gold, which is kind of more of a European background. Like it amazes me how in the US, like every time there's a news, the next question is, how is that going to impact the stock market? I keep thinking, like, if it's a new movie Independence Day and you have the aliens coming, what's the Dow Jones going to do? It's a very odd question. But one that's interesting, I mean, obviously the stock market is a fascinating object. I mean, it's the intersection of so many things, right? I mean, not just finance, but also our emotions, our representation, our belief systems. So once I got exposed to it, I actually started really, really liking it. I've always loved currencies. I collected coins as a kid, which I think is the reason why I hate the euro. I think anyone who collected coins as a kid is like, no. Suddenly you have like
a lot less coins.
Yeah, and the drawing too. These awful bridges, and by the way, that they wanted initially to put famous men and famous things. And of course, the French were like, well, obviously they need to be French things because, we're so much better than everyone else. And then the other countries in the Eurozone said, no, we need to have one per country. Like, come on, name me one thing from Luxembourg, right? So we could not agree on putting only French things on the notes. So we ended up with this kind of weird, okay, let's put a bridge. Like, a bridge is a symbol of like the past to the future, that everybody loves bridge, but that makes for a very soulless currency.
So you're slamming Luxembourg. I think that's kind of funny. I always think about Luxembourg. Aren't they known for putting mayonnaise on fries? Like, isn't that what you should have put? I think there's a lot of good things that have come from Luxembourg.
I don't know. I've picked on them for no good reason. I apologize. I've actually never been. It's 2 hours away from my hometown, and I've never been. So I just picked on them because they're small. But I'm sure there's plenty of good things. I think when I think of Luxembourg, I think of Jean-Claude Juncker, the former European Commissioner, the one with a little bit of a drinking problem. That is the only thing I know about Luxembourg.
So okay, so
Kev.
Sorry, go ahead, Patrick.
He's talking about drinking problems. Do you have a problem drinking? What are you drinking, first of all, Vincent? Do you have a beer?
Yes, I have a beer, and
or wine.
I'm doing the Euro fix. So because of COVID, I couldn't go get a craft beer. Like I live in Oakland, California, so you have a lot of it. So, but I actually did my shopping at Costco, and I bought Stella Artois, which is Belgian. So it's not the best beer, but at least I'm supporting the European economy, and I think it's slightly above like Coors Light or Bud. So I'm not, the complete savage.
So I love the Stella Artois. I think it's a great beer. So I no complaints here. I'm a big fan.
So Vincent, just quickly, and then we'll get back to the thing. Red wine or white wine? What's your choice?
Well, coming from Burgundy, it's really the Pinot that's Burgundy is known for. But if you want with like a nice, Meursault has some amazing Chardonnays as well. So, maybe, I mean, in general, if you're in Burgundy, people will say, okay, you want to go with Pinots, but you can also try the Chardonnay. You'd be nicely surprised as well.
Nice.
Patrick's our resident beer wine expert.
Yeah.
He's like, forget all this market.
Get back
talk.
to the interview, Kev.
Okay. Let's go through your career a little bit here, Vincent. Your first job is to track the flows and the buybacks. Why don't you tell us what you were doing there, where you were?
Yes, there was a small investment research shop called Trim Tabs Investment Research based out of Sausalito, California, which was really the main appeal for me because I don't know if you've ever been to Sausalito, but you really think it's paradise. I mean, everybody's good looking. There's palm trees. It's sunny all year long. The office was right on the beach. And the main insight really was, forget about the things you learn in business school about fundamentals, dividend discount model, and just track, supply and demand of stock. And really, there were two things that, especially at that time, mattered a lot. Was fund flows. Initially, it was mutual fund flows, and then progressively that's been replaced with ETF flows, and then buybacks. And really, I think buybacks still do not receive the attention that they deserve as a market timing signal. I mean, I remember back in 2007, one of the first signs of trouble was really companies no longer announcing buybacks, especially in the sectors that were going to be impacted, like real estate, like developers, eventually some financials as well, and then outright buyback cancellation. And that gave you a fantastic top signal, a signal which, by the way, also occurred this January. And that was one of the reasons why I became very negative on the market. Well, I've always been negative on the market. I've been negative on the market for the past 2 years, but I've been very negative in January, not because I really knew anything about COVID-19, but just because I could see that the buybacks were really slowing. And I think that's one of these early turning indicators that people often miss.
And so you're saying we saw that even before the virus, like the buybacks were slowing, and it wasn't just a seasonal thing in terms of at the beginning of the year.
No. Even comparing. So I look a lot of course, you need to do year-over-year comparison and stuff like that. So the problem in the US is you only see the completed buybacks, from the 10Ks, right? So you have to wait a quarter to see what actually happened. And already there, you could see completed buybacks were down about 15% in Q4, even though that was probably the all-time high for profits. And okay, kind of, you could say maybe it was because of the tax cut, right? In 2018, you had this big boost from the tax cut. So a lot of companies also were repatriating cash from abroad, doing buybacks. So you could say, well, maybe that's normal. But it was concerning. And then you get to January, February, and buyback announcements were down 60 to 70% comparing to the same period last year and the year before. So clearly there was something else happening.
Well, that's really interesting. And so one of the problems with buybacks is that sometimes they announce them and don't execute them, right?
Right.
And so, but
Right.
You're saying that even the announcements were down, like they weren't even pretending they were going to buy back stock.
Exactly. So the first thing that happens usually is they don't announce, then they don't complete, and also they cancel. And all these things happen, of course, in sequence in the past 3 to 4 months. And I think going forward, I mean, this is going to be a major difference, I think, from the post-COVID-19 world. Maybe we'll have legislation banning buybacks, maybe not. But I think the volume of buybacks is going to collapse. I mean, we were running at, 800, 900 billion a year in 2019. I don't think we're going to be at even half of that. And even if there's no legislation, I think that the stigma associated with buyback is pretty bad. The performance of buyback stocks also has been very disappointing, which is probably the strongest argument against buybacks. I mean, the only reason you want to do a buyback is if it gets the stock price to go up, right? Well, for the past 4 years, that hasn't worked. So I think CFOs will be very reluctant to do that, regardless of the public opinion.
And so when you're looking at how much of when you look at the flows over the last kind of few years, you look at the net flows, whether it be institutions, retail, and corporate issuance, and then the buyback portion. The buyback portion has been basically all the other ones have netted out, and that's been the thing that's been pushing this up, right? So if we take that out, are you therefore kind of believing we're going to have a secular decline in stocks? Like, do you think that this is something that lasts longer than just, another quarter or two?
Yeah, I would be in that camp unless there is a kind of a new actor that kind of replace that buyback as the marginal buyer of stocks. But yeah, I mean, and by the way, that is very much where the rest of the world has been in this kind of secular decline for stocks. I mean, if you look at European indices, Japan but again, Japan now has a central bank buying stocks effectively, or ETFs. But most indices outside the US, we haven't gone nowhere in a very long time. And in a way, I think it's the demographic reasons that, as people age, they need to sell stock, buy bonds, and eventually they need to buy bonds and go into cash. And we have this very kind of generationally unequal distribution of wealth, where so much wealth is concentrated in older cohorts. And that will create a structural imbalance. That creates a structural imbalance in the supply and demand for the stock market. And you see that the average, pension fund in the US has been cash flow negative for a decade now, meaning they pay more in distribution than they receive in contribution from members, and their asset allocation is naturally evolving. So before that, you had some buying from foreigners. Obviously, when we had the big asset build up in sovereign wealth funds, you had good foreign flow into the U.S. stock market, but that has slowed and even reversed since the oil price crashed in 2014, 2015. Obviously, this is not going to come back anytime soon. The banks and the broker dealers, for regulatory reason and profitability reason, are trying to reduce inventories as much as possible. So I really struggle to see what could replace buybacks as a source of close to $1 trillion in buying for the stock market.
Yeah, I agree.
That's some fascinating stuff. Now I'm going through your kind of your CV here, your resume, and it says, my second job was to run Ned Davis's Europe product and to reassure skeptical U.S. managers that the euro would not blow up, something I'm much less certain of today. So let's. I thought that was a great line, Vincent. Why don't you tell me a little bit about that job and then what your feelings are about Europe?
Sure. So I took that job in the middle of the first European debt crisis, if you will, at the time you had a lot of negativity built in the euro, like this was going to break, and I think that's generally a prejudice among North American managers. And I think it comes from an overly analytical and logical mind, where they look at the euro and they're like, well, this makes no sense. I mean, obviously, Germany and Italy have vast difference in productivity. There is no transfer. There is no banking union. But at the same time, you need to, imagination is here to offset logic sometime. And there are many things that make no sense that exist. I mean, especially in Europe. I can think of so many institutions that have greatly outlived their normal life and usefulness and still exist. I mean, the Queen, in right. England, or half of the institutions in France. Like, why do we have a Senate? Why do we have a Conseil économique et social? I mean, things can last a lot longer than they're useful for, as long as there's political will to make them live. So, and I think that's a problem that Americans have when it comes to the euro, is they say, well, it makes no sense, therefore it should not exist. And I don't agree. I did not agree with that. So right. What I would usually tell them is really three arguments in defense of the euro. One was the current account surplus, and the fantastic export machine that Europe is. I mean, people freaked out about Japan in the 80s and 90s, China in the 2000s. The biggest macroeconomic imbalance in the world by far is Germany, Netherlands, Switzerland. The Eurozone current account surplus is enormous, about $500 billion a year. And every time the euro gets cheaper, and that gets bigger, and then you add in all the tourism that comes in the south. I mean, this is a fantastic, from a flow perspective, it's just enormous. So, forget about the political circus and focus on the trade side, and you'll see that the euro will last. My second argument was about flows from oil-producing countries. There are a lot of people who do not want or cannot invest in the U.S., and the euro is the second most liquid market in the world. And we have plenty of football teams, prestigious real estate that can accommodate this flow from Russia, from Saudi Arabia, from Iran. And then my third argument was about the political circus, that Americans are believe Italian politicians, which you should never do. People are really just bluffing, and at the end of the day, no one really wanted to break that thing down. So these were my usual three arguments throughout the various European crises. To say, no, don't worry, the euro is not going to break down. Just wait for it to get cheap enough, and then trade it, in that range of like 1.1 to 1.3. And if you got these swings right, you could actually make a lot of money, even though the euro hasn't done very well as a currency.
Right. But now your views of Europe has changed. Why don't you walk us through how they've changed?
Right. So I'm going to go back to the three arguments I gave you. And really, I think none of them apply today. The first one was, the European Union is just this fantastic export machine. If goods cannot move, purchasing power parity no longer holds. And I think it's especially bad for Europe because of the specialization of the economy. I mean, our single largest export is cars. Second largest is auto part. Third largest is airplanes. I mean, you couldn't think of something worse in the COVID-19 world than these three things.
That's crazy.
And then, of course, and after that, so that's really the German part. And then if you look at the South, I mean, you go anywhere in France or Italy outside of Milan, or Spain outside of Barcelona, there is no economy. There's a government sector and there's a tourism sector, a leisure sector. And that's like 80% of the jobs in most towns. And I mean, if people are locked down, I mean, it's even if, so some parts of Europe are finally opening up, but the tourism, the season is gone. So really, it's tourism and cars. These are the worst parts to be right now.
Do you have an outlook on where you think the euro is heading? Do you have a US dollar bullish view, or do you have a bias there?
I'm not. It's hard for me to be bullish on the US dollar because of a bunch of structural reasons. I think that the politics are very messy and getting even messier. You have a balance sheet that's expanding by. Central bank balance sheet by spending by $2 trillion every 5 weeks. But my call really was more towards other currencies, maybe Asian currencies that seem to have managed the crisis a lot better. But it could be, if you were to put a gun to my head, I would think the euro goes lower against the dollar.
How about the versus the
Swiss franc? I like this guy, Kev. I like this guy.
Well,
he's a smart guy.
How about but Vincent, he's also a dollar bear though, Patrick. So he's not he's not talking your kind of language. So Vincent, why don't you walk us through the second reason? So you said the first reason, and then let's go through the three. Let's go through the three reasons why Europe is no longer the kind of destined to survive, or at least the odds of them being destined to survive are no longer as probable.
Yes. So the first reason was the trade and purchasing power parity argument. So the reason was, the euro is cheap. I still believe it's incredibly cheap. I mean, truthfully, the fair value, I think, should be 1.3. But again, if you don't have a mechanism to make that happen, if you can't arbitrage it, you can remain cheap and even get cheaper. So that was the first reason. Second reason was the euro as I call it a crypto petrol currency. So that's, if you were to overlay a chart of the euro versus the price of oil, it's fascinating. You think that, Europe is Saudi Arabia. The euro hit 1.6, I think, the month, July 2008, when we had 150 on Brent. And then the euro was in that 1.3 to 1.4 range when Saudi Arabia was bouncing the market at about $100 oil between 2011 2014. And then it collapsed with it. So the euro really, trades very closely to the price of oil. And I think the reason for that is because a lot of the petrodollars eventually get recycled in the European economy. I mean, I remember 10 years ago in London, everybody was Russian. Or if you look at France and who does big project, big real estate, it's all the Qatari, the United Arab Emirates, so much money that's flowing from the Middle East into Europe, from Russia into Europe. And that's money that's ultimately tied to sovereign wealth fund and to the great petrodollar accumulation. Now that accumulation is not happening. I mean, you had negative oil prices a couple of weeks back, and in general, it seems to me that most of these sovereign wealth funds are most likely to be
sellers instead of buyers.
yes, sellers of assets instead of buyers. So we will not have that bid. I think it really mattered. You have a big private banking industry in Europe. Real estate matters a lot. Luxury matters a lot, and that's the second argument.
Okay, now let's finish off with the third.
Well, the third argument was basically that, with every other crisis, it was circus. No one was really serious about breaking the euro. I mean, you could see that when the Greeks, in 2015, there was this referendum on the memorandum, the Troika plan to quote unquote save Greece. And they voted no. And they elected the people of Syriza, who were very anti-euro, had this very hard line. Varoufakis was the finance minister. And when these people got voted in power, it became clear that they had not even started thinking about how to break up the euro. So even the people who were like the leaders of the anti-EU, we're gonna slap the table and we're gonna walk out. They had no idea what to do, because ultimately there is a very strong consensus among the elite in Europe that things are good the way they are. And we can always, we can kick the can down the road one more time. And we're really good at that in Europe. We are really good at not solving problems. I mean, you can walk all the way to the edge of the abyss, stay there, and then just walk back when you need to. And the Americans, every time they think, oh, these guys are going to fall. No, it's a dance. They know what they're doing.
But now you're not so confident they're not going to go over the abyss. And why do you feel it's changed? Or the potential for them going over the abyss is there?
I mean, I don't think we're there yet, but I think there is like something fundamentally different that happened with the COVID crisis. I mean, before it's all about money. And, if you have family discussions around money, I mean, they get ugly real quick. But at the end of the day, it's just money. And especially if you think about the southern countries like Italy or Greece, they may hate Brussels and Frankfurt, but do they really want the drachma back? Do they really want the lira? Do they trust their politicians to be better? There's subconsciously, at least in the population, I think there was this view, well, the euro has been bad for us objectively, but I'd rather be mismanaged from Brussels rather than have the crooks of my own country, run the show. So I think that's why the euro kind of survived these economic crises. Now with COVID, it's a life and death situation, and it's a little bit unfair because technically the European Union is not in charge of healthcare policy in Europe, so it's the national government. But fundamentally, I think people expect the government to keep them safe and alive. I mean, that's before anything else. Before you can have any other freedom, you need to be alive. And the failure of Europe to produce that, at least the perceived failure, when you see the Czech Republic stealing mass that were, I think, supposed to go to Italy or France, when you see basically that, at least in the public mind, Russia and China did more to help Italy than did Germany and France. And I think that's going to leave some scars, much deeper scars than what happened with the Eurozone crisis, and also the fact that these economies cannot recover. I mean, without tourism, Greece, Italy, Spain, there is no path to recovery. I mean, right now I think the best play is just to apply to all the programs the ECB is announcing, like pandemic PPP, I forgot even what the acronym. There's so many of them, and try to get as much money out of the system and then walk away.
Yeah. Okay. So let's talk about that, because that's fascinating. And listen, Vincent, I agree with you that I thought that the COVID was the point that would make the Corona bonds and the joint finally, a true fiscal union occur. And as it became clear to me that wasn't going to happen, it becomes even more clear to me that we're quickly reaching a breaking point. And for mainly the reasons that you say, so far we've locked everyone in their homes, but as it becomes clear that there's no economy to come back to, and that the debt that they're going to saddle these countries with are just inescapable, it's going to become kind of the least bad option is going to be to leave. And so let's talk about maybe how that might look. Like, how would you see this playing out?
Well, I think you have three possible scenarios. it's hard to assign a probability on them. So I'm going to start probably with the lowest probability one, but the one that's been in the news lately, which is the German exit. I'm sure you've seen the ruling from the Karlsruhe, the Constitutional Court in Karlsruhe, basically calling the ECB, okay, rightfully so, by the way. I mean, I don't think, you can read the treaty, like, there is no, unless words mean the opposite of what they meant to be, like they shouldn't be buying $1 trillion in bonds with no capital key or whatever. So that the court in Germany just asked the ECB, like, how can you justify this? So that could technically, create a legal conflict, right? Because Germany, contrary to other countries in Europe, Germany has not accepted the superiority of European law over national law, or the constitutional law, I'm sorry. You have this legal discussion about the European Union. Is it a set of treaties, or is it something above treaties? And to me, and I think to the Germans, correctly so, it's just treaties. And in the national order, treaties rank below the constitution. So if you cannot commit to do something unconstitutional by treaty, which is what they're trying to bring up. Now, either we'll have a full conflict with that, or most likely, I think it's something that the Germans can use in order to kind of slow down this mutualization of debt, saying, oh, we'd love to help, we'd love to do bonds, but these judges in Karlsruhe tell us that we can't. So that's one risk.
But in doing so, aren't they? Oh, but Vincent, I'm sorry to interrupt, but in doing so, aren't they kind of almost assuring the eventual demise of the European Union? Like, this is the part that amazes me. You can't have a political union or a monetary union without a fiscal union. So the longer they take, peddling around and kind of putting that off, the worse the problem becomes.
Mm-hmm.
And
it's a crisis without a solution. You can always postpone it, but I cannot agree with that.
Do you think that the Germans' goal is to postpone it? Like, do you think that that's what they're trying to accomplish?
For now, yes. I think we have so much on our hand that we can't afford another crisis, and I think that is the goal for now. But the more you postpone it, and that gets me into my second scenario, the more you see I'm sure you've heard about the term target 2 balances, right? Which represents unsettled balances between the national banking sectors. The more that will grow, and it's already grown a lot. And then you could start seeing a situation where the Germans start asking, hey, maybe we need to back this with gold or some sort of reserves. Then people start moving money from, large Italian or French bank into a German bank, and you get to a point where it really becomes unsustainable. And that would be one way for the currency to break through a banking crisis. Possibly also if you have this, we set up the European stability mechanism, which has a bail-in clause. Like if a bank goes bust, the depositors need to take a hit. And we saw that happen in Cyprus, by the way. Now, if this were requested of Italians, because again, the banks, there's no way out. We have negative interest rate. We're going to have huge negative non-performing loans. We have economies that are not going to recover. There will be a banking crisis coming out of this. And if suddenly people realize that if they keep their money at, UniCredit or Santander or whatever, that they have the serious risk of getting a 20% haircut on the deposits, and they might move that, and that could accelerate things. So that would be there's another scenario. And then the last scenario would be the political one, where you get a competent populist elected in Europe. And I think that's been the issue of the populist movement in Europe is its incompetence. We had plenty of people who were trying to ride that horse, pro-nationalist, anti-EU, I'm going to defend you against Brussels, but they didn't know what they were doing. If you see a true populist movement with an actual plan to get out of the EU be elected, my best guess would be Italy would be the laboratory for that. Then you could see it done legally through Article 55, kind of what the Article 50, kind of what the UK did 4 years ago.
So under almost all scenarios, do you just avoid European assets?
I mean, it seems like a blanket statement, but it's hard when you have that big Damocles risk weighing on top of it. When you have, I think, arguably the worst COVID-19, the worst region for this is going to be Europe. I mean, you can make the case. Yeah, I still feel that there are a lot of great quality companies in Europe that are traded at very low valuations. But if you're thinking about like a broad ETF investing in European assets, no, I would not be. I don't think being cheap is good enough a reason to buy it.
Fair enough. Okay, so that was your role when you were talking about what you did at Ned Davis. You were in charge of the European product. You eventually went to FC, your current job at FCStone. Why don't you tell us about what you do there currently, and then let's get on to some of your big themes that you've been talking about recently.
Wonderful. So yeah, I run a global macro research product, which is a fancy term to describe that I get to write about whatever I like, which I enjoy. It's global macro people are people who are specialists of nothing. So I write about four reports a month. So it's the same topic that you would find in your macro tourist letter, which, by the way, has been a huge source of inspiration for me about across the years. And I mean, really a fantastic read. I mean, and you were writing on a daily basis, which I really admire. And every time you were funny, and you usually had something to say, which is remarkable.
Well, thank you. That's very kind of you to say. Although I always say, I laugh and I say I'm the Playboy of newsletter writers. Everyone says they're subscribing for the articles, but I know they're just looking at the pictures.
Well, I took that from. I mean, I can't, like, you're more you go with the memes and stuff like that. Like, you're more internet culture. I usually I use like paintings and reference from the classics too, because I have to keep a certain standard. I cannot go like, cats and internet stuff. But I love yours.
Thank you. That's very kind. And you know what, as I said, when I just recently came upon your writing and someone passed it along, and I was like, this is some great stuff in terms of, what the themes that you were talking about. So let's talk about one of the first ones, which is, I think we're on the same page, you and I, in that neither one of us are deflationists, and we actually look and see the tea leaves setting up for a boom in inflation in the coming years. Why don't you talk to me about how you see that arising?
Well, thank you. Well, first of all, it just seems so obvious to me. Like, if you had to design an inflationary experiment, you would do exactly what we've done, right? I mean, you would lock everybody up, turn off production, and just give $1,000 check to everyone, quadruple unemployment insurance, and expand the central bank's balance sheet by $2 trillion in 5 weeks. I mean, that would be, if you asked me before that in abstract term, like, how do you get inflation in the US? I would probably have shut off production, increase the money supply, and give a bunch of money to people. I mean, that seems to be very straightforward way to produce inflation. And I'm yet to hear an argument to convince me otherwise. And please don't bring up Japan, because it's not the same. And the second reason is kind of more of a long-term political generational case, which I think, I mean, people who've read Neil Howe, basically the fourth turning, I mean, let's give credit where credit is due. This is a great book, and a lot of people quote it and try to hide the fact that, it's like The Simpsons, everybody copies them and, doesn't acknowledge. So let me acknowledge the source here. But you have this massive generational problem in the United States. And you see it in the inequality debate, for example, when people talk about, inequality. And we talk about the gender pay gap, the race pay gap, and all these things may be true. Right? They probably are true. But the single biggest determinant of how wealthy you are is how old you are. And the level, and it's not just because, the older you get, the more money you make. Over time, this has grown, the gap between the the wealth of the old and the relative lack of wealth of the young. One stat that I love is that in 1982, you could buy one share in the S&P 500 with 4 days at the minimum wage. Today, you need more than 2 months. And if you think of the young people as people who just have human capital, right? For most people, we don't have a trust fund. All we have is our labor. And with that labor, we need to buy assets. Well, if you think of old people, people are people who have assets, but no longer have human capital, or that human capital is rapidly depleting. So there's a trade. The young offer labor and the old people offer capital. Well, the ratio, because of the Fed, because of lower rates, because of what happened with globalization and a bunch of other reasons, that ratio has kept going up. You could buy more and more labor with the same amount of capital. And that has resulted in a massive transfer from the poor to the old, and from the young to the old, from the poor to the rich. And I think that transfer, if anything, has accelerated with COVID-19. COVID-19 essentially kills the old. It's a very... It's like it's been designed by an economist or a demographer, and in order to save the old, you need to destroy the economy for the young. So I think that will really bring this to a breaking point. And I think ultimately I'm optimistic. I think generations find ways to solve their problems, and they can work together. But my optimism is into inflation. Inflation is the only sensible way to solve this crisis, the easiest way. And that's exactly what happened for the boomer generation. I mean, the boomers, when they grew up in the 70s, that's why they were able to build assets, because they could buy a cheap house, because their mortgage was paid off by the great inflation, because they could buy stock at 9 times earnings. This is what the young generation need. This is what we need to get birth rate going, household formation going, and eventually economic growth happen.
So why do you think that the market has such a different view, Vincent? Because you and I might agree that is where we're headed, but the market is kind of filled with people who talk about how we're going to basically for sure have deflation, and that there's no chance of getting out.
Oh, God.
Right. I mean, well, first of all, we have to acknowledge that the market's been right and we've been wrong. So I think there's just the weight of evidence here that people have been calling for inflation for a long time and been wrong. So it's kind of the kids who cries wolf. After the 100th time, inflationists have lost all credibility. I mean, I remember back in QE2 was 2012. There was a letter with the best names in finance. I mean, Jim Grant, Clifford Asness, like everybody, Stan Druckenmiller. I think they all said a warned Bernanke of the risk of out of control inflation if we kept doing this stuff, and it hasn't happened, right? So there's that. There's a Japanese precedent, the concept of a balance sheet recession. And then I think people look backwards. I mean, that's one thing we see. I mean, if you plot the 10-year yield versus 10-year inflation backwards and forwards, you have almost a perfect match on the backward, but almost a zero match on front. So the yields really only reflect the past. I mean, inflation expectations are I forgot the term now, but they're informed by the past. So if something hasn't happened for a long time, it's reasonable to think that it's not going to happen in the future.
Right. So the market looks at the past and says this is going to happen in the future. But, we could have made this argument a couple of years ago, and we would have had a couple more years of kind of disinflation without the inflation coming. Is there anything that makes you more confident that this is upon us, right now?
Yeah. One is the extraordinary impact of COVID-19. I keep going back to this idea, but if you wanted to create inflation, you would do exactly what we're doing today. Shut down production, increase the money supply, and pay people to, order stuff online on Amazon. So that is a game changer. The fiscal nature of the response, I think, is a huge difference. I think one of the reasons we haven't seen inflation in 08, 09, after 08, 09 was that, most of the money, the banks were kind of cutting credit. They were rebuilding capital. Most of the stimulus eventually ended up buying financial assets. It was just like swapping one financial asset for the other. Very little of this liquidity injection actually leaked into the real economy. I mean, there is a significant fiscal component in every country in these bailouts that was not present in 2009. And if you think about 2009, I think the US deficit was like 10% of GDP. And then by the end of the Obama years, it was like 2%. So the fiscal contraction that we had in this decade was probably one of the largest outside of the post-war period. Same thing in Europe, obviously even larger as we even went into surplus with a German surplus. So we had massive fiscal contraction in Europe at the time, which obviously this is different. And then the last part to this, which makes me more confident that it's going to be different this time, is just death. I think ultimately the boomer generation, the asset owning generation, wants high asset prices, low inflation, because they are a rentier generation. Especially now that they're retired, they make money from a claim on the tax payment of the young generation or on the assets that they have. So they don't want inflation, they want high asset prices. And generally they've designed policies that reflect these goals, high asset prices and low inflation. But the mortality rate is going to increase dramatically. I mean, if I look at Congress today, or just look at Nancy Pelosi, Chuck Schumer, Biden, Trump, I mean, how many of these guys are going to be around in 5 years? You will see, the mortality rate really kicks in once you get to 65, 70, which is where most baby boomers are today. And then it becomes exponential, and people are always surprised with exponential growth. So there will be this generational renewal that will ensure that possibly the policies, the kind of pro-growth policies that would favor the young generation, will be more likely to be voted going forward.
Right. So we're going to see a change in policy in the government. And so do you foresee them kind of continuing spending more? Is that, where you're going in terms of the governments will eventually adopt MMT and might even, take that to extremes? Is that kind of the basis of your thinking?
I think it has already. I mean, we already have MMT everywhere at this point. And I think once it'll be very hard to go back. I mean, it's the same thing that happened in Europe after 2011. We had these emergency measures that were still there 10 years later. I think it's going to be the same thing here. And progressively that will go into more themes that, were barely discussed before COVID will become obvious, like Medicare for all, like student loan cancellation, universal basic incomes. All these ideas, I think, are going to get, I would have expected these things to happen in 10 years, and it could happen in 10 months because of COVID.
Yeah, I actually have a friend that has always thought that there would be a war that kind of brought about a lot of these changes in policies. And then when COVID happened, he said, well, there it is. I actually thought it was going to be a war, but it might be a war on the virus that'll bring about the extreme kind of adoption of changes in policy. One of the things that you mentioned is say, don't bring up Japan. I'm curious of why you think Japan is not a good example, because a lot of the kind of deflationists will point to Japan and say, look, it didn't work there. Why do you expect it to work here? Why don't you give me your take on that?
Right. Well, there's a couple of things. One, I think, is the asset bubble in Japan in the late 80s was just so massive that the deflationary impact from that really would trump everything else. I mean, I'm sure you remember the anecdote that at one point the Imperial Palace in Tokyo was worth more than all of Californian real estate. Japanese stocks were like half of the MSCI World Index. Japanese banks were like 25% of that. So you really had a bubble that was so much larger, and people had borrowed against that. And then you get the concept of the balance sheet recession. I think it was Richard Koo that explained that really well. So that was much stronger than what we've seen today. They were also uniquely exposed, I think, to China, which was also a massive deflationary shock for them. I mean, for everyone for the world in general, but for Japan specifically. And then finally, the role of the private sector, I think, was different in Japan than it is in the US or in the West today. In Japan, we had these big deficits, which were indeed financed by the central bank, but you also had these big private sector surpluses. Japanese households traditionally save a lot for cultural reasons, and especially Japanese corporation, because they need to repair their balance sheet. Where just, everything that the government was spending ended up being saved on the balance sheet of Japanese corporation. So if you think of a sectoral view of the economy, there was little going on there. And then the government also in Japan kind of always shot itself in the foot with this VAT, the sales tax. Like every time something was happening, they would, I don't understand why they ever did that, but they did.
It's because they get convinced that the debts matter, and that they think that they get schooled about that they got to pay it back, and so they end up kind of worrying about the deficits, and the moment the economy gets going, they basically tax it away so that the economy can never get going.
Yeah, I see that as a low risk in the US right now.
Yeah, well, it doesn't look like they're worrying about deficits anytime soon. Okay, so I'm just going through your global macro report here, and I'm looking at how you positioned, or how you recommend positioning to take advantage of this. Why don't you walk us through like what you think will be the best asset classes as this plays out in the forward?
Right. So as a caveat, I must warn that I've been recommending people to be mostly in cash since January 2018, short-term bond and gold since January 2018. So obviously I looked very smart in 2018, very stupid in 2019, then very lucky in 2020 because I can't really claim credit for a virus. But I haven't changed all that much as far as that view, like a lot of cash, a lot of short-term quality, short duration debt, precious metal. The thing that I've added, which is somewhat counterintuitive with my core inflation, but it is, I know it's very consensus, but I think if you have to have an equity allocation right now, big tech and healthcare seem like where you want it to be. And then progressively, I think, because I do think we're going to see a retest of the low, and I think you want that balance sheet strength. I think there's still a lot more pain to come, so you want to stay there. And then eventually, once this inflationary pressure become more clear, you rotate into inflation-sensitive assets, things like basic material, things like gold, things like miners, maybe even some, I don't know, we'll see how it goes then, but maybe some Latin America equities, which have got truly decimated. So maybe that's the story for the end of the year, is this rotation from big tech and healthcare into inflation-sensitive assets.
So talk to me a little bit about that last asset, because it's kind of not something that you hear a lot of. Latin American equities, is that what you said? I missed it.
Yes,
and
yes.
Why would you invest in those?
Just as like the purest, highest beta play on inflation. Basically, you remember when we had this conversation about the euro and whether the euro was cheap. Well, you have currencies that really have been decimated, and they're all in Latin America. They are all tied to things like copper, like iron ore, like oil. So if we do get this reflation scenario that I expect, it's probably going to give you the most leverage on that play.
Okay, so just in terms of at the bottom, when the dust is settled and you really want to bet big on inflation, that's the crack cocaine of inflation betting.
Yes.
Okay, nice. So now I have a question for you. Do you think the Fed, there's a lot of talk about negative yields, and then even more talk about pegging the yield curve. What are your thoughts about the chances of either one of those happening?
I think I would take pegging the yield curve ahead of negative yields. We kind of had yield curve control already. Operation Twist it was never formalized, but I think anyway, the Federal Reserve is going to need to buy enormous amounts of government debt, and by doing that, it will implicitly shape the yield curve. So they could make that explicit. Negative yields, I really don't know. I think if put a gun to my head, I would say probably yes, that it will happen. But again, the record is so miserable in Europe. I think, I mean, it would make me very sad when it happens, because native yields really haven't done any of the things that they were supposed to do. And I struggle to see how that would be different in the US.
You make me sad too, Vincent. It really would. Okay, so let's talk a little bit about, let's wrap this up a little bit. So before we go, though, you were, a Frenchman, and you came from France, and we're Canadians, and we were chatting a little bit about Quebec. And I wanted to know your impression of La Belle Provence and our use of the language, and what you think of Quebecers.
All right. So first thing, the Quebec people have it right. It's the French who have an accent. I mean, and that's just documented. I mean, just from the time, the French people moved to Saint Laurent, the Gulf of Saint Laurent, and Quebec and all that in the 17th, and then the language stayed pure there. So the correct French is in Quebec. It's the French people who have this weird accent. And of course, I mean, the fact that the Quebec people have held so dearly to French and came up with all these cute words to replace them, and when it would have been so easy to just be overwhelmed. I mean, the French are so culturally colonized. I mean, like everybody in Paris wants to imitate Brooklyn, and then everyone wants to send their kids to U.S. University or McGill, which is the next best thing. The French are the cultural colony of the United States, and the Quebec people are really the ones that are keeping the flame alive. And they do that with great modesty, with great humor, with great charm. They have, to me, they have the qualities, all the qualities of the French and the Americans. They have the enthusiasm, the politeness, the kindness of the Americans, and then the refinement, the good food. Well, maybe not quite as poutine is not, but I mean, still better than the alternative. So yes, and I really hate. I mean, as I was mentioning to you, like when Quebec people come to France, it's impossible for them to have a conversation without talking just about their accent. And it's okay, people have accent. Let's move on. And I feel I want to apologize in the name of France to anyone from Quebec who had to oh, can you say this for me? This is so funny. Oh. And by the way, it's very understandable. Okay, Quebec French. I mean, it's very understandable. Like you have more variation between Yorkshire and London than you have between Quebec City and Paris.
Okay. That's a great story. I really like that, Vincent. Okay, let's leave it with, I always like to ask the guests, if you could go back and talk to your younger self, imagine, you as the wise Wall Street veteran that you are now, going back and talking to the young Vincent that's just graduating from the school in Paris. What advice would you give him?
It's okay to write and to tell stories. Is probably what I would say. Like people have different qualities and different strengths, and I think anyone who, at least a lot of people who started in finance with me about 15 years ago, there was this myth of George Soros and Stan Druckenmiller and Paul Tudor Jones, and we all wanted to be the next big global macro guy, the one who'd break the Bank of England, and just. There's a reason why very few people can do it, because it's really, really hard. And as far as I go, I think I'm a better writer or storyteller than I am portfolio managers. I mean, I've tried managing money. I was actually decent at it, but I could not really handle the stress. And I think on the margin, there's a role for everyone, and there's a role also for people who can tell beautiful stories.
Well, that's terrific. Well, I for one enjoy your beautiful stories, and I thank you for coming on our show. It was a real pleasure having you, Vincent. Thanks a lot.
Yeah, thanks a lot, Vincent.
It was a pleasure. Thank you so much.
All right, cheers.
Liam Vaughan is an investigative reporter with Bloomberg and Business Week magazine in London. His forthcoming book, Flash Crash, tells the remarkable real-life story of Nav Singh Sarao, a trading savant who made $70 million from nothing out of his childhood bedroom until the U.S. government accused him of helping him cause one of the most dramatic crashes in history. Liam, it's a pleasure to have you on the show. Welcome.
Thank you. It's great to be on.
I guess we should start with a big congratulations. Not only did you just recently publish your second book, but the exciting part is that it's just announced that Flash Crash will be developed into a movie featuring Dev Patel. How does that feel?
It's a strange. I mean, I've actually known about that for quite a long time, but it's great that they are now far enough along that they want to talk about it. But from my point of view, it's really surreal, and I do think it's a very cinematic story, and it will make a great movie. But I'm not too involved with that. The way it works is, they like the book, they like the story, and you sort of interact with them. But ultimately, I'm going to be as shocked and surprised as to what goes into it as I think anyone else. So that's going to be interesting as well.
Well, I see that they announced that there was a bidding war for the story, and there was a couple of movie houses doing it. Is that true?
Yeah, so the way that it worked is that I've got an agent, and I wrote a proposal for this book, and it just so happens that this agent also looks after actors, and Dev Patel was one of the actors, and he saw my book proposal, and he was aware of the story already because he is from like West London, the same as Nav, and they're almost exactly the same age. And I ended up Skyping with him, and he was saying, Nav, who's this really sort of cheeky, chappy, very sort of boastful, but really underneath it all was quite a sort of soft kid, sort of reminded him of people he knew and people he went to school with and stuff like that. So he signed up to do the movie. And then at that point, because he's such a big star, he was kind of, it was up to him to pick who he wanted to make the movie with. So he ended up picking this company called Seesaw, who, I don't know if you've seen the film Lion. It's a good movie.
Yes, they did. Yeah, terrific movie.
Exactly, and they've got a great pedigree. They sort of make independent kind of films, but with a decent sized budget and stuff. So yeah, I've actually been sort of chatting to them for more than a year. But I've spoken to so many other people that are like, have got really far with this process, and then for whatever reason, like things change, like a deadly virus.
And there's no movie made, is what you're saying.
Yeah, and there's no movie made, so I'm not, I'm not counting my chickens yet, but it looks pretty good.
Oh, that's great. So let's talk a little bit about the book. What attracted you to the story?
So I have been covering financial markets for about 15 years, and the last maybe 7 years I've been an investigative journalist writing about white-collar crime. So my last book was about the LIBOR scandal, and that was, interesting in a different way because it involved the UK central bank, and it was, affected so many people who had mortgages that were priced off of the LIBOR rate. But ultimately, it was about a bunch of white guys on trading floors at big banks. And a lot of the stories that you write if you cover white-collar crime on Wall Street are that, they're the type of sort of protagonists that you're talking about. Or at the other end of the spectrum, you get, real kind of flamboyant con artists that are really interesting in their own way, but really they're all cut from the same cloth. They lie a lot, and they kind of confidence tricksters, and they manage to get people to give them money, and then they spend it all. And Nav was just like nothing that I'd heard of before. He was like a guy who, when he got arrested in 2015, had never told his friends or family what he did or how much money he was worth. So he's sitting on $70 million, and his mum's still going to work in the chemist, and his dad is retired. And they answer the door, and there's like all these agents from the FBI and, a dozen police officers, and they shout upstairs, and there's Nav in his bedroom. So the story was just like totally, it was just intriguing. And then there's this whole other element of the flash crash, which is, is it really possible that a guy trading in his bedroom, essentially using a home PC, and a standard internet connection, can trigger a global market collapse? And so they were the sort of questions going in. And then once I started speaking to people that Nav used to work with, and when he started his career at the arcades, you start to hear all these amazing stories about how, he used to sit there in the office with like these kind of ear defenders and not talk to anyone, and was just like, Neo from the Matrix or something. The type of trading that he did. But he used to fall off his moped all the time, and it was just so many sort of funny elements to it as well that I was totally smitten as soon as I heard about it. Really.
So for people who don't realize, arcade in North America, an arcade is where you go play video games. It is also, though, a place where proprietary traders trade together. And ear defenders, I've never heard, Liam. Are those earphones? Is that what you're telling me?
No. So basically, it turns out that Nav was later diagnosed with Asperger's. So he was very sensitive to light and noise. And, if you can imagine a busy trading floor with everyone chatting, and particularly these arcades or prop shops, they're really just full of recent college graduates, everyone quite excited, very boisterous. And Nav wanted to be hyper focused on the market. So he got these ear defenders of the type that road users, if you're going to dig up a road and those big he would wear them in the
office. The ones like the earmuffs kind of deal, so that you can't hear anything.
Yeah.
Oh my goodness!
Like noise canceling.
So he sat there with his earmuffs.
Very rudimentary noise canceling headphone.
So what's the process of being an investigative reporter like? Like, how do you go and get people to open up about this story? Like, just walk us through like how you learned about it. Like you find out that he's been arrested, and then you decide this is a great story you want to pursue. What is it? What do the next steps look like for you?
So every story is different. And broadly speaking, it really is a case of just being tenacious and reaching out to as many people from all facets of it as you can. And eventually some bite, and then it becomes a bit like a kind of avalanche effect. Once you get a couple, then there know other people, and then other people will find out that you've been talking, and they don't want to not get their 2 pence worth, so they'll start talking. So it's a very gradual process. But on this particular occasion, I had a real stroke of luck, because I was working at Bloomberg in London, and everyone who was covering the story was talking about this firm Futex, which is now not in existence. And it turned out that a guy that I used to be mates with sat next to Nav for 2 years at Futex.
Wow.
They weren't buddies or anything, and my mate was a bit of a rookie at the time. But
it's tough to be buddy. It's tough to be buddies with somebody when they have those headphones on.
Well, that's true as well. But the amazing thing about it was that everyone remembered Nav even before anything to do with the flash crash, because he was just such a unusual and fascinating character. So all the people that, as soon as you reached out to them, the people at Futex were like, of course I remember Nav. He was like the guy that was trading, 300 lots when they were all trading 2 lots. And, he just had all these kind of weird idiosyncrasies. So I had a head start in that respect, that I knew a guy who had an in there, and then you just sort of follow the trail that way. But the other side of the story and the other side of the book is the investigation. And so I was lucky enough to be able to speak to the various government investigators on the US side of things, and they have a very different perspective. And so you kind of have a really great marrying of the two things. You have this guy who's going about his trading life, making huge amounts of money, and ultimately kind of makes this decision that he's going to build this algorithm that spoofs the market. And then on the other side, you have all these regulators and investigators who start piecing the story together. And there's this great start, the start of the book has got this great anecdote, because at the time they arrested him, the US authorities didn't know what they were getting into. They just knew that this guy was in the top 5 e-mini traders in the world. They knew that he'd opened all these offshore accounts and had all these companies in places like the Cayman Islands. And they also knew that he was quite aggressive on the phone with the CME. And he used to, he told one guy there in surveillance that he was going to fly to America and cut off his thumbs. So they thought that they were dealing. They didn't know. They thought they might be dealing with some, guy from a Guy Ritchie movie or whatever. And then they knock on the door, and there's Nav in essentially his pajamas. And when they look in his bedroom, there's a single bed. It's got stuffed toys on it. There's football paraphernalia on the walls, and they get sort of the reality suddenly hits them.
Now, so you interviewed a lot of people that were kind of amazed or in awe of Nav's trading. What is your impression of what made him so good?
So it's a number of things. One is that he's just got sort of intellectual capabilities that other people haven't got. So he at school found that he could just sort of multiply figures in his head without needing a calculator. He learned his times tables when he was 3, and just was one of those kind of almost like a human calculator type math skills. He also had like an almost photographic memory. And the other thing is that he was brilliant at computer games. He used to play the soccer game FIFA and was in the top like few hundred in the world at that game. And there's like 3 million players in the world. So he had sort of fast reflexes and amazing kind of talents. And the other thing he's got is incredible focus, which is something that you quite often find with people with Asperger's, that he could just sit there and watch the market for hours and hours at a time and either not get bored or not feel like he needs to make a trade. So that's a major asset. And then the last thing I would say, and this is probably the biggest thing, is that he just didn't give a shit about money. He never spent hardly any money. He didn't tell anyone he made the money. And
it was like a big video game to him. He was just keeping score with the money, right?
Yeah, exactly. He actually sort of made that analogy himself. And so, if you really don't care whether you win or lose, and it doesn't matter to you, then that is, you guys tell me, I don't know, but that must be just a huge, huge advantage.
Well, yeah, the less feelings you have, in some ways, the better off you are, because if feelings are kind of a disadvantage. Something my wife gets mad at me all the time that tells me I don't have any feelings, but I tell her that I'm finely tuned for the markets. That's why. So one of the things one of the things that surprised me about the book was actually how little he traded in terms of he didn't bang it back and forth all the time. He picked his moments and then went huge. And I thought that was kind of an interesting aspect of his trading. And I think we have a lot of traders that are listening to this. Maybe you could talk a little bit about his strategy and how he ended up making all his money.
Yeah, so Nav was a scalper, and he arrives in the markets at a very sort of, fortuitous time, because in the late 90s, you have all the pits closing down. So in the UK, in London, you had the life market closes, and suddenly futures all get traded on screens. I mean, it happens a bit more gradually than that, but and so Nav, applies for this trading arcade in 2003, and is literally within their second group of intake. And even though essentially the pits and trading on a screen, you're doing the same job. You're trying to buy and sell and make a profit. They're so different. And so Nav found that he arrived in the market and was looking at the screens at exactly the right time, when nobody had really kind of cottoned on to what they should be doing, and big players hadn't tried to disguise their trades yet, and there was no such thing as high frequency trading. There was no regulation. So if you're like Nav, who's incredibly gifted in that respect, then it was like manna from heaven. Specifically what he was doing is he was looking at the order book, the ladder, and he would look at trades coming into and out of the market, and he would very, very quickly hop in and out of the market, just trying to make a tick or two. And gradually he just sized up, so those ticks were becoming incredibly profitable. A bit more specifically, he likes to be short the market, when there was high volatility, sort of took the view that if markets are going to lurch, then they're going to do that on the downside. So he could make his ticks, but then occasionally the market would really fall, and he would be able to significantly profit.
Yeah,
yeah.
And so he would, but there was a few trades that were really kind of lifestyle change. Well, they didn't change his lifestyle, but most people would have been lifestyle changing, right? That there was ones where, it was $10-20 million at one crack, right?
So even though his sort of bread and butter was scalping, there was a couple of big trades that were actually quite different to that sort of made him. One of them, I don't want to give too much away because it's a great story and it's actually going to be extracted in like a publication in a couple of days. But he basically in 2008 notices there is some unusual trading behavior and some unusual activity in the order book of the DAX. And he, takes advantage of that over a 2-week period, and he spins up a couple of 100,000 into more than £1 million. So I'll leave that one hanging for your listeners to sort of work out who that is. But there's a great intertwining of two kind of notorious figures in financial markets history there. And then the other thing is that in late 2008, when markets were like decade lows in November after the collapse of Lehman, you had a lot of speculation in the press at that point about the bailout that was coming around the corner, the collapse of Lehman, and the decision by the authorities not to intervene there was widely considered to be a bad one and a disastrous one. So there was a sort of sense at that point that it was inevitable that the government was going to have to kind of bazooka the markets and that there was going to be a rally. So what Nav does is he just puts everything that he's earned up until that point on the line, to the point that his brokers were sort of phoning him up and asking him to put up more margin because he was everything he had was in there. And he just absolutely timed it to perfection. And so over a week-long period, I think the markets rallied like 19%. And Nav, not only did he sort of pick his spot, but he doubled down. So, after 4 or 5 days, he could have taken out his winnings, but he just piled in again. And by the end of it, he was up. He'd made like £14 million. Exactly. And the interesting thing, I think, is that, a lot of people would view that as, genius trading, or he absolutely picked his spot. But the counter argument, and I'm sure you guys, experienced, is that he got lucky and he could have been wiped out at that point, and maybe there'd be no book.
Well, that would have been bad, and there'd be no movie. So let's get to let's get to the flash crash, because I found that part of your book very interesting, and I have my opinions about how guilty Nav is versus Waddell and Reed. Yes. But why don't you kind of set it up and walk us through kind of just high level what happened, and a bit of backstory is that sorry to interrupt. I was going to say a bit of backstory is that in about 2008, 2009, Nav finds himself increasingly less profitable. And the reason for that is that high-frequency trading arrives in the futures markets. And, essentially, HFT is doing what Nav was doing, only much quicker and in a much more sophisticated way. So human scalpers, if all you're doing is scalping the market and looking at the order book, it's very tough to make that strategy work. So rather than quitting the market, Nav decides that he's going to build a machine of his own to spoof the algorithms and get them to trade in the way that he wants to. And so in 2009, he gets a programmer to build this device. He calls it Nav Trader, brilliantly. And what it does is it will just fire very, very large orders, sell orders into the market at a certain number of ticks away from the best bid. And then every time the price moves, the algorithm's set up to move in lockstep, so it never gets any closer to being hit. So what that essentially does is it just massively increases the demand, or the appearance of demand in the order book.
And this was quite early on in the days of, HFT strategies and stuff. So at that point, it actually was very successful. And so anyway, that's all a sort of precursor to 2010, which is he's only recently got this new machine. And on that day, this was the height of the Eurozone crisis. So you have all these macro headwinds. You have Greece that's essentially bankrupt, and there's talk about a bailout. You have the ECB refusing to kind of step in. You have like the pigs all going wild, in terms of bond yields. So, so it's already a very, very volatile day. And then you've got Nav just firing and firing and firing, literally hundreds of millions of dollars worth of sell orders into the S&P 500 E-mini all throughout the day. And then, it's amazing. I think whether it's coincidence depends on how you view it, but at exactly 140, he switches his algo off. And then at 141, that's when the market starts to plummet. And it falls 5% in 4 minutes. Nav made like $900,000 that day, which is not, it's not a huge amount of money if you're trading at UBS, but if you're a guy sitting in his bedroom, that's a pretty decent return.
I think even at UBS is not a bad. I think even at UBS it's not a bad day.
Exactly.
So one of the things that I didn't understand was I knew about the Waddell and Reed order that like they had been blamed for the flash crash, or not blamed, at least some of the spotlight had been put on them. But I didn't understand the specifics about how that order was placed. Why don't you walk us through the circumstances of that order?
Yeah, so I'll try and remember it as best as I can. But Waddell and Reed is a large Kansas-based pension fund. Fairly conservative, and it had been long stocks for a while. I think 90% of its portfolio was in stocks, but then that day, you have all this terrible macroeconomic data and factors and news coming, and the guy who ran the fund decided that he wanted to hedge their position by selling e-minis. And they wanted to sell 75,000 lots of e-minis, which is worth about, I think it's $4 billion
right,
from memory, which is, a very significant sell order. But the issue arose when with the execution of that order, because they didn't have a trader either executing it manually or sitting over even an algorithm. What they did is they plugged into a Barclays algorithm that they wanted to sell at a rate of 9% of total market volume that day. What they didn't specify is whether there was a minimum price that they were willing to accept, or any kind of other potential fail-safe, really. So what happens is all these factors converge, the market starts to fall, liquidity starts to dry up, and then you have like high-frequency trading firms trading with each other, and even though everyone's trying to exit the market, volumes spike, and so this Waddell and Reed algorithm is just selling and selling and selling and selling, and that only serves to exacerbate the downward pressure in the market until there's no liquidity at all. There's nobody there to buy, and the market, and the bottom falls out of the market.
Crazy.
Listen, when I heard it and read it, it seemed pretty clear to me that order meant a lot more than Nav spoofing. Yeah, maybe Nav spoofing was illegal, but it wasn't what was causing the market to go down. $4 billion of a market order with no limit price sure seems to be like a better kind of culprit. One of the things that I kind of wonder about is, do you think that if Nav had been more socially sophisticated, he would have never gone to jail?
Do you know what? I actually think the opposite, because what ends up happening is he, without giving too much away, he ends up helping the authorities build cases against other spoofers and really understand what he was doing in the markets in general. But in that process, he gets to know them, and it becomes quite clear that he is quite a vulnerable individual, and that actually he spent like 4 months in a British jail straight after his arrest, and he didn't do well there at all. And so, in a weird way, the US authorities, who wanted to throw the book at him and had charged him with 22 criminal counts and he was going to go to prison for decades, end up feeling quite conscious and maybe even sorry for him. And ultimately, the judge decides to sentence him to house arrest. But I think if he wasn't such a vulnerable character, he might well be in prison now.
So one of the things that a reporter is supposed to do is just tell the story, as opposed to have real kind of opinions about the story. But I can't help but ask you: do you think spoofing should be banned?
That's a good question. I honestly don't know if I'm qualified enough to answer that as a sort of journalist and not a market participant. But I do think that it seems odd to me that, through the history of financial markets, people have always been able to trade in whatever ways that they want, and there's no obligation to have a sort of look inside a trader's soul and determine whether they're, being honest, or, even in, famously in the Paul Tudor Jones video, he sells a bunch of orders to push the market down so he can then go long or whatever. And that type of activity seems to me like completely intrinsic in the sort of cut and thrust of markets. And there's a lot of people that think that as well, kind of finance professors. And then sort of banning spoofing, like, it makes sense on the surface, but actually the beneficiaries of that rule are algorithmic trading firms, because all they're doing is looking at the order book with, poised to wait for the market to move. They've got, statistical analysis to analyze whether they think the market's going to go up or down, and they try and jump ahead of that. And there's nothing illegal about that. But in order for that strategy to work, they need the market to be honest. And so essentially, one of the consequences of banning spoofing has been to sort of consolidate the strategies of the HFT firms, and to give other people even less of a kind of weapon to fight back against. So is that the purpose of regulation, to consolidate the firms that are already the billionaire players? I don't know. But then the flip side might be, well, if it genuinely is causing huge instability, then maybe, I don't know if there's somewhere in between. And you have to have the law somewhere.
Right. I guess the real key for me the important thing about spoofing is that you have to have the money and the capital to be able to execute that order. So you cannot go put orders that you can't actually clear. So one of the things we're talking about spoofing a lot, and one of the little gems in your book that I loved, was that I learned that spoof was actually the name of a card game invented in the 1880s by a British comedian. Can you tell us about that game?
Oh my goodness, I don't actually know that game. The only thing I can tell you about is when I was at university many years ago, and we used to go to the pub, we used to play a game called Spoof, where everyone has got like either 1 or 2 coins in their hand, and you have to go around and you have to kind of spoof, like, guess how many coins people have got in their hand.
Right. Did you do it? We did it. We used to play it for we called it birds, and it was birds for the bill. And it was, you had to guess, exactly. You had to guess collectively how much the group, how many coins they had in their hand.
Yeah.
And is that the same game? And then if you guessed it, you were out. And then the last person was the person that had to pay the bill.
And that was you, Kevin, every time.
Well, no, you know what? I will tell a story someday. I'll tell a story about that, because actually I have a very funny story on my first time when I was a young kid, making almost no money, and I ended up being the second last guy with my boss. But anyways, that's for another day. So, Liam, what surprised you the most while you were researching your book?
One of the things that surprised me is the imbalance that exists in the markets between the firms that trade and the regulators that oversee the markets. And I don't mean that as a criticism of the regulators. A lot of the ones that I spoke to were really intelligent and well-meaning people, but ultimately you have the most sophisticated hedge funds and high-frequency trading firms in the world that have got virtually unlimited capital, have got PhD maths and financial engineers coming out of their ears. And then you have people that are supposed to be policing those markets that don't even have the technology to see what's going on, and not even to see what's going on in real time, but even after the event to piece together what was going on. And a lot of the time, the people that are running investigations are lawyers. And so I think it's not that surprising when you get regulation that's made by powerful lobbying forces, because a lot of the time these regulators have to depend on the information that they're given and the advice they're given from people in the markets as to how to enforce the rules. And I think that this is an issue that's only going to continue because markets are just getting faster and faster and faster, and yet the amount of money that the likes of the SEC and the CFTC get given by Congress each year just doesn't go up commensurately. So I think that's why you end up in a situation where what seem like sometimes arbitrary rules are the things that they focus on.
Okay, so we're running out of time here, but I'm going to leave you with one last question. I kind of got the feeling as I was reading the book that you admired Nav. Am I reading too much into it?
No, definitely not. I did admire Nav. I admired his doggedness in the face of adversity. I didn't, necessarily admire what he did, but there's something in everyone that I think that wants to sort of stick two fingers up at the establishment at one point or other in their lives. And the thing is, not many people do it, and the consequences are usually not good. But Nav did that, and for that, there's something pretty punk rock about it. Even if what he did was ultimately illegal.
Well, that's great. Well, listen, Liam, why don't you tell people when your book's going on sale, where they can find it, give us all the goodies. And, I was lucky enough to read it, and I highly recommend everyone go get it. It was a great read. I devoured it in a night because I enjoyed it so much.
Thank you, Kevin. I really, really appreciate it. The book is called Flash Crash, a Trading Savant, a Global Manhunt, and the most mysterious market crash in history. It's published by Penguin. It's available actually as of today. And, it's on digital, it's on hardback, and it's also, if you can stand my voice for several hours at a time, I narrated the audiobook as well. Go forth and buy it.
That's my language.
It's a great read.
Well, thank you very much. It's a pleasure having you, and it's really nice to meet you, Liam.
Thank you, guys. I really appreciate it. All the best.
All right,
take care.
Cheers.
Okay, Lena, hop on.
Hello.
How's it going?
I'm good. I'm great. How are you guys?
Oh, we're all right. What are you drinking, Lena?
Well, last week I had mentioned about drinking mouthwash, and there was some feedback about that, so I decided to get myself a real beer this time. Well, maybe not real beer, but I'm drinking a Peroni.
Okay.
Well, that's a good beer.
Yeah.
Good Italian beer.
Yeah.
Yeah, no, that's a great beer.
What are you drinking,
Patrick?
Kev?
I'm having Labatt St. Conte.
Oh.
Ooh.
Fancy.
In honor of
You
our
actually
French
you
guest.
paid for that?
I paid for it.
No, he's getting paid to drink it.
For those Americans listening, the Labatt St. Conte might be like the Schiltz of Schlitz. Is that how you say it? Schlitz?
I think so. I don't even know.
Yeah.
Yeah.
Anyway,
of the Canadian version of it.
There you go. I'm still going with the Junction Brewery, but this time I'm cracking open their hazy IPA. It's actually one of my favorite beers. So let's give this a go and try this out.
Did you get another delivery, or is this still from your last delivery?
No, this is from when I had it delivered last time. I got like a couple different kinds of beer. So, but this is awesome. Love this.
Patrick he goes with anybody who delivers is awesome to him.
Well, they all deliver now. That's
I know they're kind of like they're adapt or die.
Yeah, there you go.
Okay, let me do
your
our
legal stuff. Yeah.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include Fed buyback aches, Musk mania, and or Boeing whipsaws.
Nice. All right, let's get on with the show.
Okay, Patrick, time for talking charts. What sort of magic are you going to regale us with today?
All right. Well, you know what? Normally we just get right into the charts, but today I wanted to actually go and do a little additional segment within the talking charts, and we're gonna call it the Ceresna Chart School. All right.
I like that picture of you, buddy. Looking very, very sophisticated.
Thank you. And so I there's two rare technical formations that very few people know about, and I just thought we would technically explain them so that everyone can add it into their library of things, right?
Okay.
And what makes it the most powerful is when we combine the two technical patterns together, and so the first technical pattern is called the Muir formation, and. And so the thing is, even in spite of the name, I suffer from the Muir formation as well. And so it's not purely technical. There's other facets to it, because usually you have to first anchor yourself on a fundamental idea. So here, for example, I'm just going to start off by when I suffer from the Muir formation. And so for one example, it was like Tesla, right? And so I fundamentally anchor myself, this thing's overvalued, and you know, the books and the management and the product and whatever. So I anchor myself on that, but then a face-ripping rally I'm short Tesla, and the face-ripping rally goes higher, and based on momentum, liquidity, and all sorts of these other things, and just like gives it to me, right? And so that's the foundation of the Muir formation. So the one I want to focus on today is the 10-year Treasury bond, and so the 10-year Treasury.
I never expected you to do the 10-year Treasury bond on me.
Right, and so there's this fundamental people out there that anchor themselves on this idea that bonds are overvalued, and there's all these reasons like inflation and other things that they're way too expensive and they should come crashing down, and then they have their face ripped off when this big rally occurs to the upside, right? And then they're like, no, I got to get short. This is just ridiculous. So stupid that these bonds are at these prices, and yet it just stays there over and over again, right?
And that is the Muir formation.
That's
Get
the
your
Muir
face
formation,
ripped off, and then zero pullback.
Right, and so this is where the second part of the formation comes in. Now, if the Muir formation is happening on something bullish, we have to invert the chart, which is really easy in the bond market because we just can look at the 10-year yield, right?
Okay.
But you would have to invert the chart for the other things. So this is the 10-year yield down there, and so this is where you match the Muir formation with the Pelican formation. I don't know. Have you heard of the Pelican formation? The Pelican formation is something important. Notice I said that 3 times. It's important to know this formation. So what you do is you draw on an arc like this, right? And you create the little arc in there. That's like Pelican's mouth, right? And what happens here is that the price kind of just dips in there like this, and then the Pelican swallows the downwards like this, and so you have this formation. It's the Pelican formation, and that's where using this technique, we can see yields are heading down to about 25 basis points or lower, and so that's an important information to know.
So Patrick, I think it's a fascinating thing, but in my case, they wouldn't quite go that long. They would just kind of go a little bit, so it'd probably only go to 35 basis points.
You think so?
Yeah, the extension of that Pelican's beak was way too long in my case. Maybe your formation would be that much, but not me. Patrick, I really like that.
Right.
That's
so anyway, but
those were some good combinations of new technical
but it's
analysis.
important.
Are you going to be submitting that to the? Are you going to be submitting that to the chartered?
For sure. The MTA is going to have this. I'm going to write a thing for the journal for sure, making sure that these technical formations are well documented. With that said, there's some pretty crazy charts going on, right? And so let's talk some serious charts.
Okay.
But the S&P got pinned in the gamma pin right into the middle of that kind of 2,800 to 2,900 zone, right in the middle. But one of the things we'll be talking about is like, is this where the short-term highs are going to come in on this? And that's it's going to be something that we're going to watch really closely. But at the same time, what is also interesting is the way that these currencies. I love the fact that Vincent was talking about the euro, and it's just so weak. All of these currencies are just right along the bottom of their ranges, very weak. Are we going to get the big breakdown? Look at the way the pound sterling has broken down in the last week. Have you been watching that?
Yeah, well, today was a really ugly day as well, right? Because there was some bad news on the fundamental side.
Getting slammed. Yeah, you look at that U.S. dollar yen, the break and holding up there. You look at the renminbi right along those lows, and that's a decade lows all along that bottom. Are we going to see that break? We can talk China in a little bit as well. Canadian dollar rolling over. Aussie dollar looks like it's slowly getting very heavy along those highs. And rolling over. So you have all of these currencies moving. Are we going to get a big breakout in these currencies is going to be one of the really interesting things that is developing. And the last thing I want to leave everyone with is just these breakouts on gold and silver. And like look at the way that this is now rolling up, and it's going to be so interesting to see whether gold can break to those 52-week new highs, because I mean that's going to basically pole vault this right up towards the 2011 highs, which are just north of 1900. And so are we going to get that breakout is one of the kind of really interesting things to watch next week. Silver really took off. Like look at that breakout. That's legit. Like and out of that midpoint flag, I mean that measures out to easily $17.5 to $19 on the upside. So these precious metals are moving. So I thought these are all ones that you have to watch.
It's pretty fascinating, Patrick, that it's happening at the same time that the dollar's looking so strong.
That is rare, actually. That's you wouldn't typically expect that to be happening. But anyway, that's your trade school. What did you think? You learned a few patterns?
Patrick, you surprised me with that, and it was awesome. Well done, buddy. I really well done. Honest to goodness, that was the best. Right. That was the best one I've heard in ages.
All right. Well, there'll be more chart school sessions to come. All right.
Okay, Patrick. This week in trading history, what do you got for us?
All right. Well, this week in trading history, we're going back to May 17th of 1976, and the conclusion of the Great Main Potato War. And so let's talk about this. So back in 1976, the Great Main Potato War broke out between the two great potato barons, resulting in the destruction of 50 million pounds of potatoes, some messy lawsuits, and one of the largest defaults in the New York Mercantile Exchange's history. And Kevin, there might just be some potato puns along the way, so try not to get too irritated.
Don't grow. Oh God, it's already starting.
All right, so let's quickly start. I'm going to ask you this though: how many Olympic swimming pools does it take to hold 50 million pounds of potatoes? Just so that our listeners have a context on this.
I have no idea. Like 50 million sounds like a lot. Like how many pounds would be in an Olympic-sized swimming pool of potatoes?
All right, it's 3 Olympic swimming pools, but it's like 3,000 dump trucks of potatoes. And
it actually makes you realize how big an Olympic swimming pool is.
That's right.
No, honestly, because 3,000 dump trucks, I wouldn't have guessed that.
Yeah. Okay, so let's get to the story. So there's a long history of corruption and manipulation. It's shocking, right? Corruption and manipulation in the futures market, especially on the New York Mercantile Exchange. Yeah. And so going back like in 1913, when speculators spread rumors that the government would halt imports of potatoes from Ireland, driving up prices, or in 1917, when importers doubled their profits by scheming with railroads to block shipments to create a supply shortage. These same strategies were used in 1976 by two hell-bent millionaires as they fought in a classic duel of longs versus shorts. It's literally like an Icon versus Ackman kind of duel in this. And so a central player in the feud was Jack Simplot, whose image is there on the chart on the page there, a self-made billionaire. So Jack invented a way of freezing French fries and made a fortune by supplying McDonald's. And so as you can imagine, he was a big player in Idaho's potato market and even customized his license plate, get this, to read Mr. Spud.
Nice.
That's awesome. I got to figure out what to put on my license plate. I got to come up with something good like that. Anyway, so in 1975, Jack speculated that the price of both Idaho and Maine potatoes was too high. And so together with some of his investment buddies, they sold short 1,000 contracts or 50 million pounds of next season's potato crops. And so word of Simplot's scheme traveled back to New York for a pair of major league wholesalers, this Casper Merson and Harold Collins, who saw an opportunity. Knowing Simplot was short, they went long and bought all the potatoes Simplot promised to deliver. Essentially, Simplot wanted the prices of potatoes low so he could buy them in the open market and sell them at the higher contract price. But Merson wanted the prices high and forced Simplot into a short squeeze. So even back in 1976, these barons would be going head to head in cornering the markets and trying to play this game. But you could say their market outlooks were in stark contrast.
Oh gosh. Is it going to continue the whole show?
Yeah, it's not stopping, buddy. And so the showdown began to heat up when the U.S. Department of Agriculture reported that the projected yield on Maine potatoes would be down 11%, which was a major blow to Simplot. So to help offset this bad news in the market, Simplot took a risk and began dipping into his own potato storages, shipping them east by rail, where he would sell them to city folk directly off the train. It sounds like he was root legging, don't you think there, Kev? All right, so the strategy served Simplot twofold. It kept legitimate yet spooked potato buyers off the NYMEX, and it bluffed speculators who used it as an indicator of excess supply. And so the deadline for the contract settlement was May 17th, back in 1976, with the potatoes to be delivered to in exchange for cash. Yet both sides in the Maine potato war had overinvested and neither could afford to lose the standoff. So nevertheless, in the week leading up to the settlement, Simplot supplied a steady flow of rail cars into the city in order to depress prices. But Merson pushed back. Now get this, he hired all the available railway cars and ordered them to stay parked in the yards.
That's awesome. That's a great tactic.
You wouldn't do that in the oil market by booking a bunch of Cushing tanks and leaving them empty to manipulate the oil markets. That only happens in the potato markets. And so when Simplot tried to bluff and sell even more contracts, Merson bought him up. You could say it was quite a game of hot potato, right? This is brutal. Okay, sorry. And now, now that Simplot was against the ropes, Merson went for the kill. And so to stop Simplot from being able to buy potatoes and to settle the contract, they started a rumor that a big buy order was coming from after the May settlement date. This would force Simplot to settle in cash. With the deadline looming and no available rail cars or excess potatoes available to ship, Simplot knew his opponents had him cornered. It reminds me, Kev, that do you know what they call someone who gets short of potatoes?
Nope.
A tater hater. I digress. Anyway, all right. So Simplot had a dilemma. he could buy back the contracts and push the price through the roof or default. Much to the inconvenience of the NYMEX, Simplot simply defaulted. And overnight, contracts of 50 million pounds of potatoes simply collapsed. That's a latke of worthless contracts, isn't it, Kev?
Yeah.
And so the lawsuit started flying. The NYMEX had settled the balance at far below the market value, clobbering investors, even though they had made the right bets. And it wasn't just speculators who were burned. That rumored large order was a lie. And so farmers who had waited couldn't find any buyers. Meanwhile, wholesalers looking to ship the orders were shut out of the rail car market because it was all booked. And so to conclude that great Maine potato war, the NYMEX fined Simplot and barred him from trading. He was later forced to pay some of the losses suffered by investors. And as for the NYMEX, they closed the market for potato futures. So that's why we don't have potato futures with wheat and corn and everything else.
That's a shame. I would love to trade potatoes.
No guff, right? And so, but looking back, looking for new ways of making money, they expanded their market into the oil and petroleum market, which would one day make history of its own, wouldn't you say?
Yeah, I would. I would argue though that there was a good trade giving up potatoes for oil.
It probably was. Anyway, so that was the great Maine potato war, Kev.
That's a terrific story, Patrick. Thanks for sharing it with us.
All right, now it's time for my favorite segment, the WTF Clip of the Week, Kev.
Yeah, so it's my favorite now as well because I've passed the job on to Taylor, who's done an outstanding job, and we're going to bring him on the show to actually introduce it and set it up. Taylor, welcome.
Well, thanks so much, Kevin Patrick. I mean, I've been a longtime fan of the show, and it's just an honor to be here with you guys. So thank you. But anyway, this WTF clip, it's this past week was pretty sad. Ben Stiller's father, Jerry Stiller, a comedy legend, he passed. Unfortunately, he's probably best known as Frank Costanza from Seinfeld. So I thought I'd do a little homage to him and all the drama going on with Elon Musk. And just kind of threw it together into something, and I hope you all enjoy it.
All right, let's see. Let's check it out.
Elon Musk is escalating his fight with the California county, restarting a Tesla factory in Fremont despite a stay-at-home order there.
This is a place of business. I told you never to come in here.
Musk tweeting yesterday, all other auto companies in the U.S. are approved to resume. Only Tesla has been singled out. This is super messed up.
Serenity now! Serenity now!
Elon doesn't seem too worried about what the authorities have to say. In fact, he practically dared the county sheriff to arrest him.
You saying you want a piece of me? Who put you up to this?
Breaking news with this. Public Health Director Dr. Barbara Ferrer suggested that L.A. County's stay-at-home order will likely be extended for the next 3 months.
Okay, that's it. We're moving.
Tesla CEO Elon Musk is threatening to move the company to a state with fewer social distancing rules.
Secretary Mnuchin wants it open.
I agree with Elon Musk. He's one of the biggest employers and manufacturers in California.
I'm back, baby!
Taylor, they're getting better, buddy.
Yeah, that's awesome, buddy.
Yeah,
that's how
really
long
did it take you?
I think that probably like four hours or so.
Not serious commitment.
Yeah, it is serious commitment, and we all thank you because it really shows. It's a terrific WTF, and now we have a new benchmark to strive for.
All right, Kev, let's go on to, before we get to the top three, we were going to do a Tales from the Trading Desk, and obviously Liam was talking about that
birds.
game, and so, yeah, the birds.
He called
so
it spoofed, but we called it birds, and I felt like I had to share. Yeah, I had to tell the story about this because way back in the early 90s when I was first hired at my bank, and they asked me how much I wanted to make, and I told them, I said, I don't want to make anything right now in terms of like a big salary. What I want is an opportunity, and if I kind of contribute to the desk, I expect to be paid and compensated well at that point. And they said, great, kid, you're going to start at $22,000 or some stupid low number like that. They thought this fool is going to work and we're going to give him as little as possible. So I start on the desk. So I'm there and putting my head down the first week. And at the end of the week, my boss, who's just he's only 5 years older than me, but it seems so old at the time. He says, we're going out drinking. You want to come? And I said, yeah, for sure. I'm in. And so we go out and we go to the bar underneath the kind of our tower there. And there's a whole bunch of people. There must be, like 15 people. There's brokers, there's other institutional salespeople, and it's just a huge crowd. And like we're ordering these beers and it's like they're coming and I can't remember. I think they were like $6-7, which back then seemed like for, a lot to pay for a drink when you could buy it for like $1. I was used to paying for it at college and stuff. So we're going all night. We're drinking. There's a whole slew of us. And then my boss says, birds for the bill. And everyone says, yeah, that's a great idea, right? And he goes, Kevin, are you in? And I go, fuck yeah, I'm in. And I have no idea what this is. And so he explains the game to me, which is that game that Liam's talking about, right? And I'm thinking this through, right? And I'm thinking about how much we've been drinking, how many of us there are there, and how long we've been there. And I'm thinking, this is going to be a big bill. Like, this is going to be probably like something that's really, I might not be able to afford. And then I think, well, there's 15 of us. What are the chances that I'm going to be the last guy? Like, I'm going to get out of this. This is no problem. So I go along. And so we're going through, and everyone's putting from 0 to 3 coins in their hand, and everyone's collectively, choosing and stuff. And we go through, and I'm watching people drop out, and one by one they're dropping out, and I'm figuring out the game as we go along, and I'm thinking, geez, I better get out soon. This is gonna be awfully embarrassing because I don't know if my debit card, I probably didn't even have a Visa at the time. I don't think my debit card had enough money in it, like to actually pick up this bill. It would have been more than I had made in the first 2 weeks of working, right? And we're going through and bit by bit, and like I'm thinking, oh God, well, I'm going to get out this time. And every time I'm so close, but I miss it. And then Patrick, it comes down to me and my boss. And I'm like, shit. Like, this is like a no-win. Either I win and my boss picks up the bill, at which point he's going to be mad at me because he's the one, or I lose and then I can't afford it. So I didn't know what to do. Well, I go through it, and lucky enough, I win, Patrick. And it ends up being that my boss ends up paying for it. And I think to myself, well, that was probably a better kind of outcome than me having to renege on the deal because I couldn't afford it. But the one thing that I did learn from this is that he was the one who called out birds for the bill. And for the years and years and years, whoever it was that would actually seem the most keen to play the game, they were always the one that lost. So even later, I was always in, and I would never say no to it, but I would never once say birds for the bill because that person would always lose.
And so you've never lost?
No, because I did try a few times saying birds for the bill, and I lost once I got older. Okay. I mean, once I had some money and I thought about it. But it seems to be that...
What a fool. You now know the rules.
I know the rules. You never play it. But it's a great game, and it's a lot of fun. And for those who are interested, you should play it, but never suggest it, because you are going to lose if you suggest it.
There you go.
And don't play it when you don't have enough in your bank account to settle the trade.
Well, no, that's words of wisdom for sure.
That is words of wisdom. Anyways.
We should use that for the words of wisdom at the end there. All right. So
okay, let's go to the top 3 things to watch next week, Patrick.
All right. Well, let's just start off with last week's. And last week we talked about Bitcoin, and no sooner did we launched the show, did Bitcoin drop $1,000+ bucks.
I know there was all sorts of coiners were mad at us.
Oh yeah, because you goochered it.
I goochered it, but I was like,
but they recovered. They recovered.
But I don't understand because we both hate it. So how was us mentioning it on the show cause it to go down?
Yeah,
it's a little bit of voodoo magic there.
Yeah, they just need someone to blame, and we were easy targets. That's it. We put the bullseye on us. So anyway, number 2, one I really did Gucci, which was natural gas, right?
I was so mad at you, Patrick, because you put it on the top 3 things to watch next week, and I said, "Don't do that. I'm long, and it's going to hurt." And sure enough, you did it, and natural gas went down.
I owe you one, buddy.
Yeah, you do.
I feel bad. I really do, because
Yeah, you should, man. Don't do that ever again. And it looks like shit now that you're looking at the chart.
Don't say something like your
chart. It looks terrible.
It looks terrible. Like the fact that it gave back, it was doing such a good job rolling off that bottom, and look, it was building a nice chart, and then. And like a pelican formation, it just like completely nosedives.
It's like that's like a rat on acid. That thing, like it's really, really a tough commodity to trade.
It is.
Someday I'll actually take some money out of that square.
You swear, eh?
I'll someday. Okay, CPI. I gotta eat some crow, right? I gotta eat a lot of crow.
Do it.
Eat it. The crow is. Actually, there's like a whole buffet of crows for me to eat. It was so bad.
Inflation. It was nice. Vincent and you could like get together and like
talk about inflation.
Have your little inflation one day will come. You'll see, guys. It's
well, anyways, it wasn't this last week is all I can say. That for sure. They came in and all the CPI and all those numbers were below expectations, which is kind of surprising to me.
1 month closer to me winning that bet from last week, right?
Which is what. I can't even remember now.
Remember we went out to 2023 with a 5% print on inflation?
Oh, yeah, but it's not going to happen. I'm not like that.
Yeah, but I'm 1 month closer now to winning.
Yeah. Okay. What do we got for next week, Patrick? What are we watching?
All right, let's go.
Next week. Don't say natural gas again.
Dude, that 20-year U.S. Treasury bond auction.
Oh, you know what my favorite part about this is? It's a 20-year U.S. Treasury bond auction on May 20th, and I think they're doing $20 billion.
All the 20s.
It's like there's like some millennial at Treasury thought it would be really funny to do that to his bosses.
There you
I
go.
do. I honestly think that.
There you
anyway,
go.
it's a 20-year bond. It's a big deal. We haven't had this issue. They're opening up a whole new issue for this. Yeah. They generally don't auction off 20-year bonds. They do 10s and 30s. And so this is a new era. And it just goes to show you that there's going to be a lot more.
Do you know if they're going to put the futures up on there for the 20 or
no? So they're not going to make any. They're not going to make 20s. They're not that I'm aware of. They will. Interestingly enough, Patrick, they are starting a 3-year.
Right.
And I think the reason they're doing 3 years is because the 2 years getting so boring. It's going to be 12 basis points for the next 2 years. So they got to go up
and
the
like
curve
the 3 year isn't going to be pinned down there either. Like I mean, they're moving out the curve, but it's gonna be the same shit. Welcome to financial repression, buddy. It's
anyways, it's a 20-year bond auction. It's actually a fairly big deal. It's a fairly big issue. It's good. It's
do you think do you think it's going to move the other bonds? Like, do you think it's going to do anything to the curve?
For sure, it's going to steepen the curve, and it already has to some extent, and it's going to continue to steepen the curve. Listen, the Treasury is going out the curve, Patrick. You might be right on the short end staying very pinned, but I think you're going to be wrong on the long end.
So here I've got the chart on the two 10s. So what you're like? What are you going to say? Like it's going like first of all, like you can go. I have some eyeballs, so if this thing rips to the upside, I guess I'm not going to totally complain. But this year, if it goes to like what do you think 70, 90? What's your call here
on the 210?
Yeah,
like oh god, that's a chip shot.
Oh Jesus. Oh, stop this. Okay, no, forget it. You know what? This is. Is there a bet going on here? Like, no, I'm ready to take the other side of that.
Okay, I'll tell you what. I'll tell you what. The high.
Give me one. Give me one second.
One second. The high was 78 this year.
Yeah.
It's now at 49.
Yeah.
How about you just give me a one-touch new high?
No.
Why?
You just said it's a chip shot. So you're basically thinking it's going to blow through that.
How about
give me the
100 basis points. 100 basis points. 100 basis points. One touch
burger.
And I'll do a steak.
But steak. Oh, steak. I love it.
Yeah.
Or let's do this.
Okay,
Steak
so
dinner for the
December
one-touch
31.
But
December 31.
Give me a time frame, though. Give me a reasonable time frame. Don't give me this 1 year shit.
December, that's like, what, 7 months?
Dude, no, you're saying that right now the 20-year treasury is going to steepen the curve.
No. I want a whole year. I want my whole end of the year. If you want it or not. Otherwise, trade or get off the pot.
I'll do a burger bet for the year. If you want a steak dinner on this, you got to go short in the time frame.
No. Okay, so it's a burger bet. December 31 burger.
1% by the end of the year.
Done. It's a one touch.
Done.
Okay.
Done.
Number 2. What do we got?
Number 2. Well, listen, will volatility return? And you know what's interesting? I saw Chris Cole tweet out there basically saying the only V recovery will be in volatility. I love it.
It's a good line. That's a good line.
It's a good line. You can see volatility has been contracting quite a bit, pinned around 30 some odd %. But if there's another leg in the bear market, we should have another return. I don't think we're going back to 80, but I think volatility could return back to like 50, 60 handle. The question then becomes, how is it going to impact all the different asset prices? Like obviously, typically with a spike in volatility, you usually have contracting markets. Currencies have been pinned. Are we going to have big volatility in the currency markets? Bonds have been like a completely narrow range. I haven't looked at the actual implieds on the bond market, but I'd have to imagine they were pretty tight.
Well, if you go look at the MOVE index, Patrick, I'll pull that up. The MOVE index had gone to, where are we here? Let me just pull it up. It had ticked at 160 and it's gone down to 56, which is the range that we were in the latter half of 2019. So the bond market is contracted to the point where it's the same as before.
I'll bet that there's going to be bond volatility beyond that. That's like the whole point here, and in commodities as well, right? I mean, obviously not in the oil market. I mean, you can't really top that vol spike that we saw in oil, but the thing is that there's a real chance of volatility. Like during this entire, and I'm still convinced it's a bear market rally. You obviously have everything kind of calmed down. Volatility contracts, but if it is a bear market, we should have a spike in vol. And now that the gamma pin going into the option expiration weekend here is gone, does it return next week? I think it's the one thing to watch for sure.
Yeah, I think that you're right, Patrick. You just go back to the bond market that you're giving me all sorts of hassle about how it's gone quiet up at this new higher level. Well, just look at that. Like, pull up the chart. Like, let's just pull up the 10-year future.
Yeah.
And look at how...
You want to look at the Pelican formation again?
No, stop with your bad jokes. Let's just pull it up. Pull up the 10-year future, and let's go look. See, look at how we've gone. Yeah. So we went from, 134 to 141, back down to 134, and then since then we've been in like a $2 range, and it just keeps contracting.
And volatility just been crushed.
Yeah, I know you think that'll resolve itself to the upside, which of course you do. But regardless, I think it's going to move. I agree with you that that's probably something to watch, which means you should be selling vol with both fists, because whenever you and I agree on something, it never works. Let's go to number 1. What do we got?
Number 1, China, dude. Obviously, things keep on a political front escalating, but now and the trade war talk is back and nice and raw. But then you have now China's National People's Congress thing coming up. How does this play out, Kev? What's your thinking?
Listen, it's getting scary and it's getting more and more ugly. I keep thinking that it was just rhetoric between the U.S. and the China, and that most of it was for the domestic consumption, meaning that like when Trump goes and says bad things about China, he's just doing that to appeal to his base, and when China says bad things about Trump, they're just doing that to appeal to their citizens. But I'm increasingly worried that it's real and that there's more going on behind the scenes. And one thing I would suggest to people, that if you don't know Peter Zeihan, Zeihan, I believe. He's got a great blog out there, and he had a couple of articles this week about China and how this might actually be much more serious than the market realizes. I think those are, something that I would highly encourage readers to go check out. Peter Zeihan, and he's got a great piece on China, and I think it's something to watch.
But do you think it could be the catalyst that drives the stock markets to to weaken on there? Like,
Listen, the stock market is
could this
definitely
be a stock market catalyst?
The stock market is definitely watching every headline and selling off. And I do think that it could be, if we get a situation where tariffs and all of a sudden, like, let's just stop and think about Apple for a second. Like, let's imagine that China actually does something to Apple, which is probably the most vulnerable of U.S. industries or companies, because let's face it, it's the second biggest company on the exchange, and they build most of their stuff in China. Yeah. And what could happen is that we could get a situation where China's retaliating and hitting us in a hard spot, which is Apple, and we could get the stock market collapsing from that. Now, I'm not trying to predict that. I'm not trying to predict that.
But it's a risk. You have to in the back of your mind. It's and you know what? Buying hedges right now is the cheapest in a month. I'm not saying it hasn't been cheaper or anything, but maybe hedging the bet here is not a bad idea. Well, I know you love buying the hedges. In the year 30 seems cheap to you. I still think it seems more expensive. But well, then collar it. Offset it with an offsetting call on the upside, right? Like that's where I will say this, Patrick. I know we're both probably. I'm not as bearish as you, and not only that, I don't think we hit new lows. I think the range we've
for
had
the
this
year.
Talk. I'm not opposed to the idea, but on balance of probability, I think we're going lower than the previous low. But I wouldn't be necessarily shocked if we didn't make. We did have a pretty heavy crash, and we're pretty far off of there. I mean, we could have a 500 S&P point drop, and we still don't make a lower low, and that could mark a retest of the low, and the bottoms could come in there. I mean, it's entirely possible. I certainly don't want to say that you're going to be wrong, but I still think it's going lower. Yeah. Well, anyways, regardless, China's National People's Congress is the number one thing to watch next week, because China is going to be increasingly on the headlines. Put it up there. Keep your eyes peeled for it. Watch for the South China Morning Post as well. Lots of articles in there that seem to be very bearish. Lots of saber rattling. I assume it's going to get worse as we go forward. And not only that, think about Trump. Trump was elected basically making a boogeyman out of China. I don't see that changing anytime soon. He needs someone to blame, and I think that's going to continue. Right. And so let's go on. Time for parting words of wisdom. And you picked this one? I did pick this one. A little JFK. Do it. Okay. All my life, I've known better than to depend on the experts. How could I be so stupid? JFK. I thought that was kind of funny. Thank God we're not experts. Yeah. Well, having said that, I would agree, like that sometimes some people might consider us experts, but one of the things that we differ from is we're willing to admit that we're wrong. And I think a lot of times experts get out there and they tell you they know for sure that this is going to happen. Kind of like me with inflation. And this is where, there's a difference between trying to find situations that are the probabilities are, in your favor and the difference in experts. And this is often why, remember we had Victor Adair on the show, and he said that his over the years of being a commodity broker, his worst clients were engineers and doctors. And if you think about it, those are professions where they are experts, and they're very rarely wrong, because if they're wrong, it costs lives. So they do everything very, very precise and exact, whereas we are much more. We just make shit up as we go, right? Like, well, but not only that, we're willing to admit that we're wrong and drive on, because after people die. Yeah, I was wrong about that. So one of the things is, let's hope that the engineers and doctors are not doing that. One of the things that I had one of my good friends came and watched me trade, and he says, "How do you do this? Because you're kind of making decisions based upon 60% of the information." And I said to him, well, if you wait for all the information, then it's already built in and it doesn't actually help anymore. Yeah. And he said, I couldn't do your job because you're always living in such a level of uncertainty that it actually would be paralyzing to me. And I kind of think that is the difference between a trader and others. But I thought that this JFK, quote was actually quite interesting in that, when someone's an expert, I always kind of worry too much. When someone's too convinced of something, it always makes me
a little bit wary.
There you go. All right, so let's wrap up this show, buddy.
Okay.
Lena, you're gonna have to come on here and give us
you do the wrap up,
because we suck at this, Lena. You know what? Getting people to give a thumbs up and liking the show and stuff. What is it that our listeners need to do?
That if they could follow us on Twitter at The Market Huddle.
Yep.
Nice.
And also check out our YouTube channel if you haven't. If you're just listening to this on a podcast platform, please check out our YouTube channel, and you can subscribe there and ring the bell so you can be notified whenever there's a new episode out.
No, ring the bell so you can be irritated by the fact that we're having another episode up, right?
Nah. Lena works hard on these. You can't say that.
I'm getting irritated by your comment.
Yeah. So let me finish up. I actually know how to do this, I think.
Okay, go for it. Go for it.
A big thanks to Vincent.
Yes.
It was a great interview. It was a lot of fun. Also, thank you to Liam for coming on. It was actually quite exciting for us to interview our first true author. It was kind of exciting, and I got to read his book ahead of time. It was a great book. I highly recommend everyone to go check it out. And then a big thanks to Taylor, who came up with the WTF and saved me those 4 hours of work, although it would have been more like 4 minutes for me. And that's it. Thank you very much for tuning in. And Patrick, where can people find out more about you?
You can follow me on Twitter at Patrick Ceresna and find my stuff at bigpicturetrading.com. How about you, Kev?
I'm at Kevin Muir, and if you want to check out my letter, you can go to themacrotourist.substack.com. And, if you want a couple old versions, like sometimes I know that it is a pay letter, but I do pass out kind of older ones for people that are interested. If you want to see some samples, just email me, kevin@themacrotourist.com, and I'm happy to send you some old kind of
nice
posts. Anyway, thanks a lot for listening, everyone. Have a great week. Stay safe. We'll see you next week.
Thanks, everyone.
Okay.
All right. What a wrap. It's what did you think of Lena, what did you think of me talking charts? Was it all right?
Sure.
But you understood the note. You understood the formation, right?
All jokes aside, yes.
Okay, good.
And considering that I don't really have any finance background, I mean, that was a good nugget of information.
Yeah. And Taylor, you're there, buddy. Great job on the WTF, bud.
Yeah, thanks so much. It was a lot of fun doing it. So I do it because I love it.
Oh, that's awesome. You take it up a notch. You're embarrassing Kevin now.
You're not, actually. It's a pleasure having you. Like it's great.
That's great.
Yeah.
But speaking of which, you guys saw that picture that Taylor had sent, right?
No. Where is this?
You guys didn't see it? It's in the email.
What?
With Jerry Stiller at Elon Musk. I'm gonna throw it up here.
All right, throw it up. Let's take a look at this thing.
You gotta look at it because it cannot be unseen.
That's awesome. Elon.
How do you, Taylor? What do you use to do all your editing and stuff?
I use a Premiere Pro, I think. Adobe Premiere Pro.
Are you an Apple guy or are you?
Yeah, I'm an Apple guy.
Okay.
Yeah.
Oh, is this where you're gonna make a millennial comment?
Wow.
No, I'm not. I was an Apple guy for I honestly I remember so originally when I was on the trading desk we used Unix systems, and so we were kind of like true Unix guys. And then when I went off on my own in the early 2000s, I started using PCs, and then I got frustrated because the PCs sucked so bad. And they kept breaking, and it was a disaster, and the blue screens of death. And I remember that there hit this point where Apple put Intel chips into their computers, and at that point, you could dual boot them. And I was one of the first to at least amongst all my friends and stuff that weren't Apple guys, because most finance guys are not Apple people. They've become at home, but back then nobody had Apple. And I remember I got one, and I was like, okay, I'm going to try this out to play around with it. And my wife and kids at home would have trouble with the PCs, and I gave it to them, and I never heard. My wife used to phone and say, "How do I do this? How do I do this?" And I gave her the Apple, and I never heard from her again. No, she didn't leave me. She just knew how to work the computer. And so I became a huge Apple fan, and I eventually ended up, we got all of our computer systems were actually those big, huge cheese grater Mac Pros. And we used to actually buy Apple and then run Windows because we had to do it. So I've been an Apple person forever. Having said that, I once they stopped making those Mac Pros, and once they pissed off Adobe, they didn't. A lot of those Adobe products are actually run better on Windows nowadays, and they no longer they focus more on the phone, and they've not worked as hard on their computers. I have now gone back to being a Windows person.
I'm there.
So, I don't know. Have you, Taylor? Have you tried Windows recently?
No, I think the last I did was 2016 or something like this, like Microsoft 10 or whatever.
Yeah. Well, that's still the one they have, Windows 10. But it's got. Listen, I understand the attraction to Apple, but Windows 10 is pretty darn good now. I really do. I honestly believe that it's almost as good as the Apple one, and it's less money, and there's a bunch of other reasons that for me as a finance guy, I can run all the software. And so in the past, I used to have both. I used to run my Mac at home, and then I would actually have a MacBook. And now I'm just forget it. The Windows is good enough. So I'm no longer an Apple guy, but I do not.
Do you also have an Android phone then?
No, so I have an Apple phone because the Apple phones are definitely better. And
I just can't get used to the fact that the X is in the top left versus the top right. I just can't get used to that shit.
Yeah.
That's what you can't get used to.
That's it. That's it.
Not only that, Patrick,
when you use it, I don't close the stupid thing.
When you close it, that actually doesn't shut it down. It just closes the window, and it's actually still running in memory. So it's even worse than that. You have to actually file exit it to get it out of memory. But anyways,
never do that.
Anyways, listen. Taylor is a hip happening millennial, and he of course has an Apple MacBook.
I think most millennials do have Apple.
Yeah.
I mean, it's just easier, right? You get an iPhone, you get your MacBook Pro or whatever, and then everything syncs up, and it's all user friendly. It looks pretty. What's not to like? Oh, except for the price tag, I guess.
Yeah.
Oh, that little thing. That little thing.
That little thing.
Because millennials are rolling in dough, right? They're getting their boomer
they're
parents
getting it on
to buy
financing.
Well, millennials are a wide group. I think you're talking about the next one, Patrick.
The Gen Zers?
Yeah, millennials. Some millennials.
Yeah, millennials can afford it. It's true.
Yeah, millennials are actually older than we think. You're putting them into too broad a bucket, bud. I just had to go and buy one from one of my kids that got into architecture school, so I had to buy a MacBook, and I was like, "Holy smokes, you got a better computer than me."
Some of those computers are more expensive than rent.
Yeah, for sure. Oh, well, anyways. Okay, so let's talk shows. Lena's already told me she hasn't watched my shows. She refuses to watch them, obviously.
No.
Has anyone
I'm not
seen
refusing.
anything good? We'll start with Taylor. Taylor, you seen anything good this week?
We watched, I think it was number one, no, didn't. But we watched a bunch of stuff. We watched, I think it was Hush. It was like a Writer in the Woods kind of horror film, because I grew up terrified of horror, but my wife got me into them, and I think the first one horror I saw was Conjuring, which is one of the scariest horror films. But since then we've been trying to get that. Yeah.
I can't sleep just listening to I can't even I get triggered. I can't sleep if I hear Conjuring.
Oh yeah, it was a bad one, and since then I've been trying to chase that high, trying to find some other ones.
Wait,
so
I don't even know this movie. What is it? The Conjuring?
Yeah, Conjuring. It was, and I think they did a Conjuring 2. It was probably about 5 years ago.
It's fairly recent.
They are really scary, really scary.
Oh, I didn't know that. I got one of my kids is huge into horror films, so I should watch it with her. I know that actor.
I can't deal with any of the horrors. I still have nightmares about seeing Saw 10 years ago. That was enough for me.
So wait. So Patrick doesn't watch them. Taylor loves it now. He never had one, and he loves it. But you have trouble sleeping, and Lena has trouble sleeping. Yet you watch it as well.
Yeah, see, for me, when I'm watching a horror film, I can watch it, no problem. It's not like I have to close my eyes or anything like that. But it's always the aftermath because I have sleeping problems, and seeing movies like that, I'm just wide awake at night. So I have to manage it differently.
Every creak on the floor is
I have to watch it during the day. I can't watch it in the dark or something. I get weirded out.
How about you, Taylor? Do you have trouble sleeping or no?
No, I don't.
Yeah.
No. I used to just be scared looking at the covers of the movies growing up, right? But now it's all good. I'm not nothing scares me anymore, which is
nothing.
Yeah, nothing at all.
You should try being short bonds.
Yeah, that's right. That's
you won't be able
scary.
to sleep. You won't be able to sleep at night. I can assure you this.
Actually, you know what's funny? I know my positions are too big when I get up in the middle of the night to check them. That's true. And then it's even it's even scarier when they're limit up against you or whatever.
It's even scarier when you're looking at your P&L.
That's right. So I actually do have a funny story to tell you about horror movies though, because my wife is very scared of them. And I was telling her, she was talking about the fear of stuff under the bed. Now, Lena, are you afraid of stuff under the bed? Like monsters and stuff?
No, see, that was never my
so I'm
thing.
what the hell?
Kid,
I said the same thing to her. I said, that's insane. She says, aren't you, I'm always kind of scared about it. And I was like, that's ridiculous. And she goes, well, it's like a kind of a residual of when I was younger. So I'm telling her how I've never been scared of that, and it's not a big deal. And wouldn't you know it, I have a dream. And it's a week later, so I don't really understand how it was. I could understand if it was that day. And so I hear somebody under the bed. So I go and I look and I see a head and shoulders. So I go screw you, buddy. What are you doing under my bed? And I grab him and I pull him out. And the trouble is that it's just a head and shoulders. And then the rest of him is this alien creature kind of weird horror movie thing. And it scurries away. And it freaked me out and I woke up.
Thanks for sharing, Kevin. This is great.
Did you look under the bed after?
Someone tell me what that means, because I don't know. It was kind of freaky, though, that I had this dream, because I told them that I'm never scared of it, and then I had this dream.
Oh, yeah, you have issues.
No
That's
shit.
kind of what
No
it comes
shit,
down
I got
to.
issues. So, Taylor, I interrupted you.
Really...
What was it? What else did you watch? You watched this one thing. What else?
We've been watching. We keep regular on RuPaul's Drag Race. I've seen every season of that, every episode. Which is, I'm telling you, you gotta watch it. It's amazing.
You're not gonna watch a sashay away.
Yeah. And then my wife's been watching The Shield, which is it's like an HBO show from the early 2000s maybe, and it's just an early version of The Wire.
Okay.
So it's really good. Yeah, it's really good.
How about you, Lena? What did you watch? Oh, wait, by the way, The Shield got 90 tomatoes, so that sounds good.
You and your tomatoes.
I love the tomatoes, although we should talk about it because Patrick's movies did better with the tomatoes than I would have expected.
Mm-hmm. Yeah, you got to think twice about those tomatoes.
No, I love the tomatoes. I'm sticking with them. Lena, what did you watch?
I actually really enjoyed watching The Last Dance.
Oh.
On Netflix about Michael Jordan.
Yeah,
it's like a docuseries.
Yeah.
Oh, it's so good.
You're good.
It is so good.
Yeah.
And everybody on that show or everybody in the documentary, when they talk about Michael Jordan, it's like they talk about him like he's a god.
You know
and
what?
You get to see why.
Do you know what the sad thing about this conversation is, Lena? You're having it with three men, and none of us have watched it, and you're sitting there going, I'm the only one that's watched this. These three mopes have not watched The Last Dance. I do want to watch it. I did hear it was great.
It is so good.
I thought it was a chick flick, so I didn't.
The Last Dance.
Yeah, I would have watched it.
Well,
but
I mean,
I'm not a fan of hockey.
Well, in a way, it is kind of like a chick. It's a whole bunch of athletes, you see athletes, right? So.
Oh, there you go.
But
okay.
Yeah, you gotta watch it. It's really good.
Well, Lena, your recommendations are probably going to get a lot more play with most of our listeners than the rest of us.
There you go.
Okay, well, everyone, it's a great show. Thanks for everything. We'll see you next week.
Yeah, take care, guys. Have a great weekend, everyone.
Thanks, guys.